We ask that everyone turn off or silence your phones. Photographs and videos of the program are strictly prohibited. Thank you.
5, 4, 3, 2, 1.
Ladies and gentlemen, welcome Pat Padalino, Barron Capital Chief Operating Officer.
Wow, that felt amazing. Thanks for clapping with me for the 2 seconds that we were able to do it together. Good morning. It is my honor to welcome all of you to the 32nd Annual Barron Investment Conference. It's really wonderful to see, thank you, really wonderful to see all of you here in the Metropolitan Opera House and in David Geffen Hall. I also want to welcome those joining us via live stream from around the world. It's so great having all of you. On behalf of everyone at Barron Capital, thank you for being part of this incredible tradition. What began as a gathering of clients has grown into a community of long-term investors united by shared values and a common goal. For 32 years, this conference has connected us, clients, colleagues, and partners, around the belief that patience and vision create lasting value. Our theme this year, Changing Lives, perfectly captures the heart of who we are at Barron Capital and what we do. Above me, you'll see a breathtaking image from the James Webb Space Telescope, a nebula where stars are formed, where light emerges from dust, and where, through energy and time, something extraordinary comes to life. That image is more than beautiful, it's symbolic. As Ron Barron often says, exceptional takes time. You don't always see the moment a star is born, or the moment an investment, a company, or even a career begins to shine. But with commitment, discipline, and belief in what's possible, transformation happens. Since Ron founded Barron Capital in 1982, our mission has been to change lives. We've done that by creating wealth for our shareholders, for our institutional clients and the people they serve, and for our employees, their families, and their communities. Because wealth is more than numbers on a page. It's freedom. It's security. It's opportunity for our children, grandchildren, and generations to come. That purpose has guided us from managing $10 million in our early days to approximately $46 billion today. And it continues to inspire the way we invest, the culture we've built, and the relationships we cherish most. You'll see that spirit throughout today's program in conversations with extraordinary leaders whose companies are shaping the world's future. Joe Mansueto of Morningstar, Eugene Hall of Gartner, Martin Hoffman of On Holding. How cool is that? I love Ons. Harley Finkelstein of Shopify, and this afternoon, Elon Musk, joining Ron for a special virtual conversation on the future. We also hope you'll see that spirit in our deep bench of portfolio managers, executives, and other Barron employees you meet today. It's going to be an inspiring day, one that reminds us that long-term investing is about far more than markets or metrics. It's about people. It's about impact. Together, we continue to build something extraordinary, something that truly changes lives. Before I conclude, one important reminder. Ron will join us on stage before the lunchtime break to announce the winners of the annual Tesla Door Prizes. To win, you must be in your seat when your name is called. Can I say something? Just be in your seat. I find it so upsetting. Every year, the first person gets called, they're not there, the next person wins the Tesla, and I feel like that person, the first person, spends the rest of the day sad, and we don't want anyone here to be sad today. So be in your seat. Thank you. And for those of you in David Geffen Hall, a special third door prize will be announced. I want to thank you again for spending time with us today, for your trust and partnership, and for giving us the opportunity to change your lives. Let the day begin.
Josh, take one.
How long has Barron been researching and investing in financial companies?
Barron Capital has been investing in financial companies for decades now. Within that category, I think there are two types of companies. There are balance sheet businesses, so think banks and insurance companies, and then there are also capital light businesses, companies like payment businesses that aren't held back by regulatory capital requirements. As growth investors, we tend to gravitate more towards the capital light financial businesses, just because the growth prospects tend to be better. That being said, Barron also has been very successful in investing in a select few balance sheet businesses that have been able to grow much faster than their peers over an extended period of time. A stock that I've held in my fund since inception is MasterCard. MasterCard is the second largest global payment network, and it's a technology company that facilitates digital payments between consumers, merchants, and banks. What I really like about MasterCard, though, is that it is benefiting from the growth of consumer spending around the world and also benefiting from the secular shift from cash and check to digital payments. There's still $20 trillion of consumer payments that have yet to digitize. So still a very long runway for growth for MasterCard. It's nearly impossible to replicate the network that they have built over many decades. What differentiates Barron is our focus on growth companies run by outstanding management teams. As a result, those companies tend to grow faster for a longer period of time than the types of stocks that our competitors might invest in.
Please welcome Andrew Peck, Barron Capital Co-Chief Investment Officer and Portfolio Manager of Barron Asset Fund.
Great. Thanks. Good morning, everyone. I'm excited to introduce our first speaker, Joe Mansueto. Joe's the founder and executive chairman of Morningstar. Morningstar is the gold standard for providing independent, unbiased information that helps investors decide how to allocate their investment dollars. As you'll hear, 40 years ago, Joe basically founded Morningstar in his garage. The company has grown to generate more than $2 billion in revenues with 11,000 employees serving investors across the globe. We first met Joe when he took Morningstar public 20 years ago, and Barron has been a shareholder ever since. In addition to his work at Morningstar, Joe owns two soccer teams, the Chicago Fire and FC Lugano, and Joe and his wife have been generous philanthropists. Before we speak with Joe, here's a quick video about Morningstar.
Every morning at Morningstar starts with a simple mission: empower investors' success. Help investors put their capital where it matters, into strategies they trust, portfolios they can stand behind, and in a future they can feel confident about. That means confronting a system that often falls short, where the truth gets distorted, decisions drag, distractions blur, and powerful forces stand in the way.
We don't accept that.
And we never have.
That's why at Morningstar,
we clear the way.
Wherever the barriers are,
We break them down.
when information is hidden,
We shine a light.
When data is siloed,
we make it speak the same language.
When markets get noisy,
we focus on principles that endure.
and when power is locked up,
We widen access and return control.
Because we don't just believe in better investing, we believe in better markets. Markets that are fair, accessible, and built for investors. Fix what's broken. Fight for better.
One decision, one investor.
One market at a time.
Morningstar. Nothing in your way.
Good to see you.
Good to see you.
All right, Joe. Well, thank you for joining us this morning. Let's start at the beginning. You grew up in Munster, Indiana, and you founded Morningstar out of your house when you were just in your 20s. You know, I'd love to hear a little bit more about that time. Maybe first you can tell us a little bit about what it was like growing up in Munster, and were you tempted to go into the cheese business?
Well, first of all, thank you very much, Andrew. You know, I'm delighted to be here. You know, I have such admiration for Ron Baron and your whole organization. Morningstar, we track funds. We've been tracking funds for 4 decades. So I've seen a lot of fund organizations, and I generally believe that this is a best-in-class organization. You know, there's a very clear investment philosophy that permeates the Baron funds, emanating from Ron. And then it's not only Ron, but he's hired great talent all around him. He treats shareholders like yourselves as partners. This meeting is emblematic of that. He writes, I think, among the best quarterly reports in the business. I enjoy reading them every quarter. And then most importantly, the results have been fantastic. So anyway, I'm just delighted to be here and have such respect and admiration for Ron and everybody at Barron's. And so in terms of my background, yes, I grew up in Munster, Indiana, and I had a great childhood. You know, one of 4 children. My dad was a doctor, my mom a nurse. You can see how they met. And, you know, just a classic childhood. A lot of unstructured time, and I didn't come from a business background. And so one of the things I did growing up, just out of curiosity, was small businesses, selling trees, Christmas trees at Christmas, or soda from my dorm room. And so that led me into business. I went to the University of Chicago as an undergrad and studied liberal arts, so Thucydides, Herodotus, Plato. And then I went to business school right after that. And I went to business school with the idea of becoming an entrepreneur. And so I built on that. But then in business school, I went to the University of Chicago's business school. I got exposed to investing. And at the University of Chicago at the time, and they still do, espouse a efficient markets philosophy. You can't beat the market, fire your stock analysts, invest in passive funds. So I learned that, I got it, I understood it, but it didn't excite me about investing, to be honest. But fortunately, I came across a guy who today is very well known, but at the time was pretty obscure, Warren Buffett. And I read the Berkshire Hathaway reports, and that's when the light bulbs went off, and I got so excited about investing. And here was a philosophy I could understand, a guy who did it very ethically, with humor, enthusiasm, and it just really turned me on to investing. And just, you know, a little anecdote, when I first looked at Berkshire Hathaway stock in the late 70s, it was under $300 a share, the Class A shares. Today it's $750,000. That shows you how obscure Buffett was. But that's what led me into investing.
Interesting. So back in the early 80s, when you founded Morningstar, the investment universe, as you said, was quite different. Right? There was no internet. There was no CNBC. I think Bloomberg was just first getting started. So what was the key problem you identified, or the key opportunity that led you to found Morningstar, and what were you trying to do for investors way back then?
So when I was a stock analyst, which was what I did before founding Morningstar at Harris Associates, I had all of this information to make a stock decision. You know, fundamental research going back decades, charts, analyst reports. And then when I looked at the fund world, one, I could see it was growing. It was maybe 300 billion in assets. Today it's 25 trillion, just by way of comparison. But when I looked at the fund world, if you could find it, it'd be one line of total return data. That's all you had to make an investment decision from back in the early 80s. And I knew enough about investing to know that you need to know a lot more than total return. You need to know who's running the fund, what the philosophy is. You may have two funds that each earn, say, 15% compounded over 10 years. So same return. One gets there like this, very volatile. The other gets there in a very steady, stepwise progression. Those are two funds for two different types of investors. So what I wanted to do was to bring fundamental analysis, like I had as a stock investor, to fund investors to help them make better investment decisions.
So who were your first customers when Morningstar started?
So my first customers were individual investors in the United States. That's who I wanted to help achieve better outcomes. Those were the people buying funds. Those were the people I thought needed help. So I targeted individual investors. So we reached them through ads in Barron's and Money Magazine, direct mail, but it was all direct to individual investors.
Interesting. So clearly, Morningstar, 30, 40 years later, is a much different and much larger company than it was way back when. Can you give people in the audience, maybe a little less familiar with the company, a little perspective on what Morningstar entails today, what your major product areas are, and how you've expanded beyond simply the world of covering mutual funds?
Yeah. So we started with individual investors, and what we found pretty quickly was that financial advisors, or stockbrokers as they were called back then, loved our products because they could help their clients get into better funds. And then once we had a big audience of individuals and advisors, then the institutions wanted to work with us. Why? Because their end clients were using our analytics to make their investment decisions. So we built it from the individual investor to the financial advisor to the institution. And then we moved from the US to global, and we're in 30 countries around the world. And so what we have today are very large investment databases. As I mentioned, we started with mutual funds, but we've expanded really to any type of security that could go into an investor's portfolio. So equities, ETFs, variable annuities, fixed income, private companies. We want to help investors with their total portfolio. And what we've done over 40 years is, starting with mutual funds, to continually find other investor problems to solve. So we went from mutual funds to closed-end funds, to variable annuities, to separate accounts, to equities, and just expanding the circle of what's in this database. So these massive databases that go back decades. And then on top of that, we layer our proprietary analytics. So think of classifications, style boxes, ownership zones. Our analysts figure out proprietary metrics to distill the information in these vast databases and help investors, give them the tools they need to make better investing decisions. And then on top of these proprietary analytics, at the top is ratings. We have both quantitative, you may know our mutual fund star ratings, but we also have qualitative ratings, medalist ratings. We have 400 plus analysts who write qualitative research on all of these securities, evaluate them, and then ultimately come up with a rating. So we're helping guide investors to what we think are the better funds, or the funds most suitable for them. and trying to help them achieve better investment outcomes. We're an extremely mission-driven organization. I see changing lives here as the theme of this conference, and that resonates with me because it's very similar to Morningstar. We want to empower investor success, help investors achieve better outcomes, and give them the data, the analytics, and the recommendations to do just that.
So clearly you've watched the investment markets evolve over nearly 40 years at this point and seen various fads come and go, various asset classes grow and shrink. So if I could ask you to look into your crystal ball and prognosticate as to how the investment landscape is poised to change over the next decade, call it, both in terms of asset classes, but also importantly, artificial intelligence, which I'm sure we'll get into. How might that also be, an important influence on the way people choose to invest in the products they have an opportunity to invest in?
Yeah, it's a big question, Andrew. You know what, when I look back over 40 years, the world I started in was so much simpler. There were, 400 mutual funds. There weren't all the different types of vehicles that we have today. And so over 40 years, the investment industry continually comes up with new products, new vehicles. We help investors sort through that complexity. So ETFs were not around when I started. Private markets had not been developed, private credit. So all these new asset classes have emerged. I think most recently, the big growth is in the private area. So whether it's companies staying private longer or on the private credit side, lending to private companies, is where we've seen dramatic growth, especially over the last 5 years. The number of public companies 10 years ago was 8,000. Today it's 4,000 public companies. Companies are staying private longer. In your portfolio you have SpaceX and others that are private. And investors, Stripe, a lot of the AI companies are private. And so more companies are staying private. The venture capital industry, the PE, private equity industry, that has emerged over the last 40 years. And we're one of the largest trackers of that private market area with our PitchBook platform. We have PitchBook as a Morningstar company, and so we've been tracking that. And so I think the private markets are going to continue to grow. I think also the credit ratings business, we are the 4th largest credit ratings firm in the world. And we got into the credit rating business in 08-09 when the big three fell down on the job. And we thought there was a need for an independent perspective. And that's a very fast-growing part of Morningstar today. And the capital markets are displacing what banks traditionally have done. It's cheaper, more efficiently. The capital markets are more nimble. So a lot of new asset classes are emerging. Financing, data centers, single-family home rentals, a whole new, category of things that need to be financed. So I think the credit ratings business is going to continue to grow quite strongly. And then maybe finally, the move to passive, I think, will continue. That's been a big shift where active management is no longer really a growth industry. There is exceptions like Barron, but I think for the most part, most asset managers faced headwinds. And there's a big shift to passive, and I think that will continue. We have an index business, and we're just about to acquire a company that it's called CRSP, the Center for Research on Security Prices from the University of Chicago. And they supply Vanguard with benchmarks. So the Vanguard Total Market Fund is benchmarked to the CRSP indexes. So that's $3 trillion of assets that are benchmarked to these indexes. So we're one of probably the 4th or 5th largest index provider globally. But I think the passive market is going to continue to grow. And then maybe the last part of your question about AI, it's very interesting. Investing in my mind is part science and part art. It's hard for me to see it being fully science because to be a great investor, you need a thorough understanding of the past. You need to have a really good understanding of today, but most importantly, you have to have a view to the future. You know, when Ron Barron bought Tesla a decade ago, I'm not sure AI would have given him the answer that this is a great investment. That's the art of investing, to marry all three of those things, the past with the future, to come up with a view on how to structure a portfolio. So I think AI can help. It can be that science to help gather data, do some analysis. But at the end of the day, there's got to be a person, I think, that's got to have a view to how the world is changing and how to position a portfolio in an optimal fashion. And so, you know, there's been what's called robo-advice around for a long time. You know, that automated portfolio management. It's never really caught on. I mean, there's a small subset. Will AI, you know, accelerate that? Probably. Will it take over? I have a hard time seeing that because at the end of the day, I think you need a human to look forward and understand how to position a portfolio. And if it's all automated, not everybody can be above average. You know, you need some human element, and I think that's always going to be important.
And what about AI as it relates to Morningstar itself? What are the opportunities to use AI rather to make Morningstar presumably more relevant for its customers, and also to perhaps make it more efficient as an organization?
Yeah, when I look at Morningstar today, I think one of the most exciting things going on, and this is probably true of many companies, is AI. And we're fully embracing AI. And just by way of background, we have a history of adapting to technological changes over 40 years. When I started 40 years ago, everything was data-based when I started. It's the first thing I did is create a database. But the output was print, because that's how people wanted to consume our information and advice in print form. PCs had not proliferated like they are today, and so we sold print products. Then in the mid to late 80s, if you remember this technology, we sold floppy disks. And then in 1990, CD-ROM. And then in 96, 97, the internet came along, changed our products mix to the internet, mobile. So all along the way, we've adapted our offerings to the latest technologies. And what turns us on is trying to harness the latest technologies for the benefit of investors. And so the next wave of this, and it's a tsunami, is AI. And so there are lots of applications for that at Morningstar. We're in what I think of as the AI augmentation phase. So we're augmenting all of our processes with AI. So you can imagine collecting data. We can do that more efficiently, more expansively, increase the number of securities we track. Coding, you know, we have thousands of developers at Morningstar. We can code much more efficiently. And then where I think it gets really exciting is where this is headed. Oh, then I guess on the product side, we're building in AI into our products today. So for example, 2 years ago, we launched a tool, an AI assistant called Mo for Morningstar, that you can query and ask it to look at our databases and ratings. And so we've added these tools, you know, into our products, various AI assistants. But I think where it's all heading is this AI native world, going from augmentation to AI native, where really the whole value chain from beginning to delivering a product to a customer, you know, is done with AI. And it'll take a while to get there, but you could imagine a Morningstar intelligence platform with Morningstar models, maybe a Morningstar GPT, where you could query it and say, why did a rating change? A portfolio manager change? Should I be concerned? You can be much more interactive with our data, our analytics, our ratings. And so it'll give us that ability. Imagine that every data point we have, every analytic, all of these proprietary analytics we have, all of our ratings, every keystroke of an analyst is going into this model. And then all of the interactions we have with millions of individual investors, hundreds of thousands of financial advisors, thousands of institutions, all of those interactions are captured and put in a model that's self-learning and getting better. And ultimately, to me, kind of that's where this is headed. But right now, we're augmenting everything. We're getting more efficient. But ultimately, having Morningstar models, we have today our data available on what are called MCP servers, Model Context Protocol servers, where our clients can ingest our data, our analytics into their models and do whatever they would like with it. And it's all permissioned. There are audit trails. We can monitor usage. And so that's kind of a hybrid where we give access to our proprietary analytics and data to our clients through these servers, and that's been extremely well received.
Interesting. So I guess we've established that the investment world is becoming more complex, more diverse every day as a result of all these trends, AI among them. I guess I'm wondering, as someone who's been both a business leader but also an investor on a personal level for 40 plus years, are there any simple investing habits you could recommend for our audience as to the best way to sort of to have their portfolios remain appropriately positioned and focused given the changes that you described?
Yeah, I think a key thing is being long-term. I think where investors get tripped up in the investment industry is by being too short-term oriented. And it's difficult. There's so much information coming at you. CNBC, you're looking on the internet. And so there's this motivation to change your portfolio, buy new things. But I think you end up spinning your wheels. You bear, transaction costs, taxes. You look at successful investors. Look at Buffett, look at Ron Barron, how long he's held Tesla. And I think just, sitting on your behind and, getting a good portfolio, getting great companies, and being patient with them. The bulk of my wealth today is in Morningstar stock. I've held it for 40 years. And holding something that long, you let compounding work for you. And so compounding is the eighth wonder of the world, and you need to get compounding working for you. And so a lot of it is behavioral. And I think you're in a great fund organization with Barron, and so staying the course. And Ron is great at that. He's got some of the longest holding periods. I mean, he bought Morningstar stock 20 years ago. We went public in 2005, and I still remember the meeting in your beautiful offices overlooking Central Park. And I think it was the most in-depth meeting we had. We had about 80 meetings with fund managers around the country when we went public. And Ron and his team, conversion rates and renewal rates, and you really went through our business with a fine-tooth comb. But you've held our stock for 20 years and done very well with it. And that's true of a lot of your holdings. But I think having that patience is a key part of investor success. We look at what we call investor returns, and we compare them to total returns. Investor returns are asset-weighted returns. So sometimes a fund will have a great record, but there are very little assets in it when they achieve the great returns, and there's a lot of assets later. But if you dollar weight those, there's a big gap, often 200 basis point difference between the total return and the investor returns, because investors are switching out in and out of funds, and then there's transaction and taxes you have to pay. So I would say patience is the main thing, and then finding great companies and a manager who can find you great companies. And equities outperform bonds, bonds outperform cash over the long term. So if you have a long-term horizon, being in equities, I think makes the most sense. And so those would be some of the pieces of advice.
Great. Morningstar has a somewhat unusual position in the way it chooses to deal with institutional investors. Could you maybe describe that briefly for the audience as to what that is and sort of the philosophy behind it? Because I think it's one of the things that makes Morningstar unique and is very consistent with your company's values.
Yeah, so one of the things that we do that's a little different than most public companies is that we only meet with our shareholders once a year. They can come to our annual shareholder meeting, ask all the questions they'd like. We answer all the questions. In the interim, we say if you have a question, put it in writing, send it to us, and then once a month we gather all of those questions, we answer them, file an 8K, post them on our website, so everybody's getting the same information at the same time. One of the things I didn't want to see was that we had side conversations with bigger investors, give them information that we don't give other people. So we wanted to give everybody the same information at the same time. And then I thought it was important to keep our management team focused on building value and not running around the country to Wall Street conferences trying to promote our stock, which doesn't add any value. And so what makes shareholders happy is increasing the intrinsic value of Morningstar. So I want the management team focused on that, not promoting our stock. And so the management is totally focused on growing sales, profits, and we don't promote our stock. And markets are efficient, and so when we release our earnings, the market adjusts to whatever those are. So no matter how much promoting you do, when you release your earnings, the market will adjust to that. So it's kind of pointless in my mind to do that anyway, not a good use of management time. So again, the idea is to keep management focused on building value and then give everybody the same information at the same time.
Great. So Joe, you stepped aside as CEO about 10 years ago and remain executive chairman. I guess I'm curious how your role at the company has evolved over time, and importantly, I know the culture at Morningstar is very dear to you. How have you ensured that the culture remains consistent without you as CEO on a day-to-day basis?
It's a good question. So yes, when I turned 60, I started Morningstar when I was 27. So when I turned 60, I decided to step up to a executive chairman role. I love the company. I love investing. It's a huge passion of mine. I love the people. I love company building. I love growing the company. So I didn't want to leave. I want to continue to grow it. But at the same time, I do have some other interests, and I'm not going to live forever. And so at 60, it seemed like a good jumping off point to pursue some other things that I wanted to do. And also just have more time to read, spend time with my family, take care of my health. And so I made that transition. And then when I told my board I was going to do this, I told them when I was 58, and they said, oh no, you don't want to do that. 60 is the new 40. You should really stick around. And I said, no, I'm really going to do this. And I said, and I've got the guy who I think should succeed me. He's running our products, global products for Morningstar, Kunal Kapoor. And they said, yeah, we know Kunal, we like him, but we don't really know him that well. You're the founder. What we would recommend is a two-step process. So let's make Kunal president, give him some other areas, sales and marketing. We'll get to know him better, and then see how he does. And so we did that. When I was 59, Kunal became president. The board got to know him better. And then when I turned 60, I passed the baton to Kunal, and it was the most seamless transition. Kunal, we hired right out of college into Morningstar, into our development program. We have a rotational development program. Kunal had worked in most parts of the organization. He headed up our fund analyst group, worked overseas. Most parts of the company he had worked in. So he lives, eats, and breathes the Morningstar culture. And so it was, from a culture perspective, I think pretty seamless. We spent 6 months going around meeting clients, town halls, internally, client. And so our clients said this was the most non-event transition we've ever seen. It went very smoothly. Kunal and I have a great relationship today. We are texting each other on email most days. We get together physically at least once every 2 weeks for lunch. So I'm very involved. I'm executive chair. So the board is here, management is here, and I'm kind of in the middle. So I get pulled into things that a board member wouldn't do. And I love doing it, whatever I can do. I tell Kunal my role is to make you successful and to make the company successful. Let me know how we can help you. But you're right, Andrew, the culture is, I think, one of our biggest assets. We have people who really embrace our mission of empowering investors. People come to work at Morningstar because of that mission. And I want to make sure that continues. Kunal, that's in his DNA as well. And so I have a real high degree of confidence that culture is being continued on to that next generation.
I've heard you describe the 3 core attributes of Morningstar as including research, technology, and design. The first 2 are not terribly surprising. The third, design, might be a little surprising to people. Could you just touch on why design is so important to you and what that means in the context of Morningstar?
Yeah, that's exactly right. Research, technology, design. Design is another passion of mine. And design to us is not merely things aesthetically beautiful, looking aesthetically beautiful, but it's about information architecture. How do you array all of this information so that it's digestible to people? Because that's one of the big problems people have. They're overloaded with data. And so how you construct a page with the graph and what goes under the graph, and you can make connections. So this information architecture is a big part of that. And then I think from a personal level, I want to be proud of our products, that they're well engineered, and that also do look aesthetically pleasing, but that are easy to use. And I think we embraced design before design got popular with Apple and others. Our logo, for example, was designed by Paul Rand. Paul was probably the preeminent graphic designer of the 20th century. He did the IBM logo. He did Steve Jobs' Next logo, if you remember that, the old UPS logo. He only did 1 or 2 projects a year, but he took on our project. So the Morningstar logo has come from Paul Rand. We invest more in design than I think any of our competitors. We have a lot of designers at Morningstar, a big design program, and it's holistic. Maybe you got a sense of that on the video that we played before I came out. But if you walk through our offices, you've been to our offices, they're very well designed. They're all open environment. Nobody has a private office. All the conference rooms have glass. There's no, I wanted it to be very transparent. And everybody works together very collaboratively. And I wanted an office environment that facilitated that. And then if you go around the world, I was just in our Toronto office a couple weeks ago, it looks the same as Chicago, it looks the same as Sydney, as London, and it all looks the same, and we can move people around. So this design element, it has many touch points within Morningstar, from our products to our offices to our marketing, and it's something we take a great amount of pride in.
Great. So in the last little bit of time, let's talk about something fun. You own 2 soccer teams.
I do.
Which must be the fantasy of a lot of people to one day be a sports team owner. What has been the best part of that experience for you, and have there been any difficult parts?
It's been a lot of fun. One of the things I wanted to do when I stepped down, when I turned 60 from Morningstar, is diversify my assets a little bit and invest in my passions. And one of those passions is soccer. And I grew up in Indiana. I didn't have the opportunity to play soccer, but I think I would have loved it. It was football, basketball, baseball. But my kids started to play soccer. And when they were really small, I coached them. I was one chapter ahead of the rule book and how to play this game. And then they went on to play club soccer and high school soccer and club soccer in college. Then we started as a family to watch it professionally. And I just got hooked on the sport. 90 minutes, nonstop action, you're on the edge of your seat, and it fits very well into modern lifestyle. 2 hours all told. Some of the other sports are 3-4 hours. The US is catching up to the rest of the world. So I think from an investment perspective, it should do well. And what I learned is that there's 3 legs to owning a soccer club. There's the business side, which I have a comfort around that. You've got to sell tickets, sponsorships, you have a sales force. So that I knew. There's the sporting side, which I was a neophyte, and I had to learn about how do you sign a player, how do you put a roster together, how do you hire a coach. So that's been a whole learning curve. I've had some missteps there, but I finally, I think, have a great team in the United States. I own the Chicago Fire, part of Major League Soccer. We have Greg Berhalter, the former U.S. men's national coach, as our coach. And then the third leg of the stool, which I didn't have enough full appreciation for, was the community side. We touch every neighborhood in Chicago. There are 77 neighborhoods in Chicago. We have a presence in each one of them. We have after-school programs in low-income parts of Chicago and Chicago public schools. We have 10,000 to 12,000 kids in our youth programs that feed up to our academy, to our reserve team, and then to the first team. But all of a sudden, the mayor wants to meet with you, aldermen want to meet with you. You're very involved in the city and the community. And people view the team as a club, that they are members of this club. And I feel like I'm a steward of the club. And so it gets you much more deeply involved in the community, which has been great.
Great. Well, thank you very much, Joe.
Thank you, Andrew.
It's been wonderful.
Thank you very much.
Right. So we'll walk off together.
Small cap is anything with a market capitalization of a company 1 billion to 4 billion for us. And the hope is to buy them when they're small, hold them, and see those businesses flourish to be mid-cap and large-cap companies.
The Barron approach is as really being long-term investors in what we think are high-quality businesses. We come about those or find those businesses through our own deep fundamental research. So now in small cap, understanding that this business is of high quality or it has a great growth runway is not as obvious. When companies get bigger and succeed already, well then everyone knows Apple is a great company, but not a lot of investors have ever even heard of the companies that we're starting to invest in. But when we get to know a company is to try to not see where it's going to be a quarter from now or not even a year from now, but to try to see where it's going to be 3, 5, 10 years from now. The best businesses really do have to kind of build infrastructure, lay the foundation to enable themselves to grow. Very often, those are the best times to be involved in investing in those companies.
Small caps over a rolling 10-year period have outperformed larger caps 75% of the time. So there is proof that investing in small cap with an active manager, I believe, can really be fruitful to investors. It's less covered by sell-side research. There's more opportunity to do due diligence and fundamental research. I think the management teams are more open to talking to you about their businesses.
The most successful investment that the fund has ever made is in a company called TransDigm, which makes proprietary parts for the aerospace industry. They sell them to the original equipment manufacturers, but when they need to be replaced because they've worn out, in essence, the owner of that plane can only buy that part from the actual original manufacturer of that part. So they really have an incredible proprietary business.
Talk about a moat around a company.
And because, the company earns EBITDA margins of over 50%, which is extraordinary because of the moat that you're citing. So it's really the best business model that I've come across in, my investment career, and one that even though it's appreciated, multiple fold, I still believe the company has a long runway of growth, and the stock can continue to perform from here.
Please welcome to the stage Neil Rosenberg, Portfolio Manager of Barron Growth Fund.
Good morning. My name is Neil Rosenberg, and I'm the co-manager of Barron Growth Fund. Our next speaker is Gene Hall, Chairman and CEO of Gartner. Gartner provides actionable and objective insights, guidance, and tools to executives and their teams. Gene first joined Gartner as CEO in 2004. At that time, Gartner generated just under $900 million of revenue. Under Gene's leadership, Gartner has grown dramatically. It's entered new markets, launched new products, and expanded into new geographies. This year, Gartner will generate almost $6.5 billion of revenue, which is more than a 7-fold increase. This represents 10% annual revenue growth sustained over 21 years, a remarkable achievement. Gartner's now entering the AI era, where its analysis and insights are more critical than ever. We see a long runway for growth ahead, and we think that Gartner's next phase of growth will be even more exciting than its last. So please join me in welcoming Gene Hall, Chairman and CEO of Gartner.
Well, thanks, Neil. So I'm going to give you a little overview of Gartner because it may be a business you're not as familiar with. So I'm going to start with our clients, because it's important to know who the audience we're trying to serve is. And our target audience are C-level executives that report to the CEO, and then the direct reports of those C-level executives. So you can think about chief information officers who are responsible for technology at companies, and then their direct reports like chief information security officers that are responsible for security, application leaders, heads of IT operations, and so forth. So chief information officers is one category. Another would be chief human resources officers and their direct reports. Another would be chief financial officers, chief supply chain officers, chief marketing officers, chief sales officers, chief customer service officers. Basically, any of the functional roles that report directly to the CEO, and then the people that report to them. So those are who our target clients are. Now, each of those clients have strategic priorities. The company has strategic priorities, and they get translated for each of those executives. So if you're the chief financial officer or the chief sales officer at a company, the company has some objectives. That gets translated into objectives for you as well. And we have what we call mission-critical priorities. It's the things that that executive has to accomplish for them personally and for the organization to be successful. Every executive has these mission-critical priorities. And these are hard things to do. They can take months or years even to accomplish. An example in today's world would be that many CEOs are asking their executives to do is to develop an AI strategy for their function. It could be HR, it could be an IT, but develop an AI strategy. And again, they're very challenging. And then to give you a sense for our scale, Neil talked a little bit about this, of these executives, today we have about 80,000 of them as clients. So you can think about 80,000 of these C-level executives and their direct reports. And then we have it across 15,000 enterprises. An enterprise would be a company that's got 100 million more or revenue, as well as public sector institutions that you can imagine. We also serve every industry, and again, both private sector, public sector, and we're very global. We're in 90 countries around the world. So that's our target audience. What we give those executives are a set of insights that let them be successful with these mission-critical priorities. And they're written insights on things like best practices, future directions, common pitfalls, benchmarks, and so forth. Now, one of the most important things that our clients rely on us for is to be independent and objective. If you're one of these senior executives, it's hard to get help, get advice from people that are not have a bias in one or another. So for example, if you're a technology provider selling an executive some technology, you're of course going to want to have that executive buy your technology, even if it's not the best for their particular application. And so we're independent objective, which executives value greatly and rely on. Now, we develop these insights through a set of world-class experts. We have 2,500 experts that are functional experts in their discipline, and they're among the best in the world in the particular area that they're in. So, for example, it might be cybersecurity, or again, it might be some aspect of AI. Now, these are experienced, as you can imagine, these are experienced professionals. They develop over a period of years. Most of them would be in their 40s, probably. Some a few younger and a few older as well, but they're experienced professionals. Now, we take their experience, and they are among the best in the world when we have them, but we don't rely on that alone. There's a lot of proprietary data that we use. So first of all, our analysts, we call them, our experts, have more than 500,000 one-on-one conversations each year with these 80,000 executives. So they'll be talking to a chief information officer and say, you know, what works in terms of how you structure your cybersecurity department, how many roles you have, and so forth. By doing that across hundreds of organizations, thousands of organizations, we get a picture in terms of what's working and what's not working. So there's these 500,000 annually one-on-one conversations we have. In addition, we talk to vendors. So the technology providers, their CEO or their heads of product lines brief us on what products they're developing. We do 27,000 of those a year as well. And again, that's another set of proprietary data. We also, from our 15,000 enterprise clients, they provide us with a set of benchmarks. For example, you know, how much cost do they have in each aspect of their business at a very detailed level. So there's thousands of these cost benchmarks within any individual enterprise, again, across thousands of enterprises. And then in addition to that, of course, we have a research team that does proprietary research, things like, like market surveys and things like that. So we take the expertise of our analysts with the input we just talked about, with all this proprietary data, they convert that into these written insights that are independent and objective. And again, help these executives address these mission-critical priorities. Now, our services are subscription-based, so you pay an annual subscription. It's typically a multi-year subscription, and it's purchased by the individual executive. So it would be the CFO or the CHRO, et cetera, that buy the services. And that gives them access to our library of content, as well as unlimited calls with any of these experts that we have in various disciplines. And to give a flavor for it, the cost of one of these subscriptions, it ranges depending on the service level, but you can think about $80,000 per year. Now, in addition to that, we hold conferences. A lot of executives would like to get together, go off-site for a few days, and have a conference where they meet with other peer executives. So I just got back, in fact, yesterday from Barcelona, where in Barcelona we had 6,000 senior IT executives, and they were meeting there to hear our experts talk about different parts of information technology. In today's world, a lot of it was AI. Not all of it, but I think 30 to 40% was on AI in today's world. And in addition to our content, they get to meet with thousands of other peer executives. And we set up ways that they can actually find executives that have similar kinds of problems and talk them over with them as well. And in fact, just to give you a flavor, at those sessions, at that conference I was just at, which is typical, we had about 600 distinct sessions that these executives could go to. Now, that's kind of an overview. Let me give you a couple of examples to kind of illustrate how we actually help these executives. So again, we help them solve problems, and these are the really difficult problems, again, what we call mission-critical priorities. One of the ones today across every single function of the business is artificial intelligence. And because we do all of these analysis of the technology providers, and because we know what's working with the end users, we know more about what AI use cases are working and how to get value out of it than anyone else in the world. And so these executives come to us and say, okay, my boss, my CEO said, hey, we've got to get some productivity improvements out of AI. If you read in the papers, this is a really hard thing to do. And so we help them figure out for their function, for example, in HR or in finance, what are the applications for AI and how do they set up a program to actually realize those benefits? Another example, in fact, to give you a flavor for AI, we have more than 6,000 individual documents on AI for our executives to help them with these mission-critical priorities. And to put it in perspective, if you read 10 documents a day, it would take you almost 2 years to get through our current library, and that's growing every day. So there's a lot of content there for our executives our executive clients to use. Another example that's very common in virtually every enterprise is worried about cybersecurity today. And so a lot of our clients come to us and say, how do I develop a world-class cybersecurity organization? And the dilemma they have is it doesn't generate revenue. It only has cost. But if I don't spend enough on cost and I get hacked, it can put the entire enterprise at risk. It can be existential for that particular enterprise. And so what we help them figure out are things like, how much are you spending? How many people should you have? If you have a chief security officer, what should their skills be? How much should you pay them? Where do you find them? And then with their direct reports, how many direct reports should they have? What should their responsibilities be? And so forth. And then what processes do you set up to make sure that you're actually tracking to ensure you have the right kind of cybersecurity capabilities? And so those are the kinds of things that we work on with our clients in terms of the kind of mission critical priorities that we help them solve. So that's a quick overview in terms of what business does. And the way I like to sum it, the way I like to sum it up, which fits with the theme of the conference of changing lives, is we guide the leaders who shape the world. That's our 15,000 enterprises with 80,000 executives in 90 countries. So with that, we'll have a Q&A session.
Great. Well, that was a great introduction. I like the new tagline, or maybe it's not new, but it's new to me. So let's go all the way back to the beginning. So you joined Gartner in 2004 after having a very successful career at ADP and McKinsey. At that point, Gartner wasn't growing. I think the perception was that the market for Gartner services was saturated and the competitive environment was wildly irrational. So I think the question is, what did you see that others didn't see, and why did you want to join Gartner at that time?
So I saw two things, really. One is that there was a massive opportunity. From having worked at McKinsey and also, again, being at ADP, it was very clear to me that executives had a clear need to help solve these mission-critical priorities, and Gartner had a way to do it that was very, very cost-effective, more cost-effective than anything else these executives could do. So the first thing is that there's this huge market opportunity. And to your point, Gartner hadn't really seized upon that. And so, in terms of profitability, they were at break-even, basically. They weren't growing, and they really didn't understand the market. Like, Gartner's key market at the time was chief information officers, so the IT departments. And I had actually been a chief information officer, so I kind of understood how those clients think. None of the leaders at Gartner at the time had been actually been in that role and understood how clients think. And so they made some mistakes because they didn't understand clients well.
And so when you stepped into the role and you saw this opportunity, what did you do? How did you begin to restructure the business to position it for sustained growth?
So the first thing I did was, if I looked at how they handled problems, and as I said, what Gartner does is help executives solve problems. They were very focused on the problems, not the role. So when I introduced Gartner earlier, I said we serve these different roles: CIOs, CHROs, CFOs. The way Gartner was structured at the time is we solve problems. Well, the problem with that is, let's say you're helping a chief information officer transition to client-server computing or to digital business. Well, there's demand for that, and then the demand goes down. So the reason Gartner wasn't growing is they would help clients with one problem, and they would get demand with that, and then that problem would get solved, and then they wouldn't be on the next problem, and so they had to kind of run as fast, creating new areas just to get to break even with the ones that were in decline. And so the first thing we did actually was to change it. Instead of being focused on problems that change, focus on helping the roles, because the roles are always there. So client-server computing may be a thing in the past, not today. Digital business for companies may be a thing in the past, not today. But there have always been chief HR executives, there have been CIOs, there have been CFOs, and so forth. So the roles are everlasting. And again, what we do then is just make sure we're on the right topics for those roles. So that's the first thing we did. Another one was the company wasn't good at keeping current on what the most important things were, which of course is critical.
Right.
And so we basically revamped the research organization to make sure that we were on the most important topics. Another area is that because they weren't growing, they obviously weren't growing their sales, I shouldn't say obviously, but they weren't growing the sales force, and they weren't very sales oriented. And it's clear to me, if you're gonna have a growth company, I saw the potential to grow this business, as Neil said at the beginning, at double-digit rates for a very long time. To do that, because you're selling to individual executives, you need to actually have a sales force to call on them. And they had actually, over the past couple of years before I joined, been shrinking their sales force. And in a business like this, where you're selling to the individual executives, you need salespeople to call them to explain it. Part of it is, just as I was describing to you, this is a sale where it's not taking another product and saying, hey, you have a Samsung phone and I'm gonna give you an Apple phone, but you know what a phone does. This is, you're not using anybody. Let me explain to you why you need Gartner. And first, you need salespeople to be able to do that with these clients. And so we expanded the sales force. We also changed the culture to be much more sales-oriented, which in a growth company, you want a sales-oriented culture. And then one other thing we did, which is kind of, I find interesting, but it turned out to be a big deal, which is, it is common for many industries to give discounts to clients. And so the company basically, clients would say, we'd like a discount for your services. And sort of say, they'd say, what? You know, fine. And then the more they bought, the bigger discount they got. So the sales force was spending all their time negotiating discounts with clients, not talking about the value of the services. So one of the things we did, we came in and said, there's going to be no discounts. And what it does is it forces the sales force to focus on the value. Now you might say, well, how can you do no discounts? Well, as I mentioned earlier, the price of our services was, think, $80,000 a year. And it was cheap, it would have been cheaper back then, maybe $60,000. Yep. And the budget of a typical client of ours would be like $100 million. And so whether it's $60,000 or $65,000 or $58,000 wasn't the issue. The issue was, I'm not using this service. Is it worth me spending another $60,000 or $80,000 out of my $100 million, $500 million budget to actually get these services? And so by getting rid of discounts, it not only helped us on the revenue side, but more importantly, it made our sales force focus on selling the value to the clients, and that was really transformational for our clients and our sales force.
It's striking that even here, even sitting here today, 21 years later, the business model is right. The changes that you implemented then are still relevant and still the core, still the core of the business today. It was pretty amazing.
Actually, I found one funny story on the discounting. So at the time, you can imagine, our salespeople were a little nervous having to go to clients and say, we have no discounting. And the reality is, again, having been a client, I understood this, which is, it's not that the $5,000 is important in the discount. It's that I don't want to pay more than the next person. I don't want to be taken advantage of. And so we basically said, everyone's going to be paying the same amount. And we said, if you have any problems, call our CFO. We told all of our salespeople, so we had, 600 salespeople at the time. We said, if you have a client that says, hey, I don't believe this, or I can't believe your next whatever, call our CFO, who's actually in the audience today.
Yes, and, I'm sure and I'm sure he's willing to give out his cell phone if anybody
I think they got
complaint.
one phone call from clients because it was credible that we were saying, we're going to have everybody pay the same amount, and people were okay with that. Our clients were okay with that.
Great. So during your introduction and during this period, you talked about how Gartner serves roles, including HR and sales, but the legacy of the business until about 2017 had really been focused on IT and perhaps supply chain. In 2017, you made a big acquisition. You bought CEB to expand the breadth of your offerings. I think it was met with some skepticism in the market and from this seat as well. Talk about why that was an important deal, the opportunity that you saw, and how you've brought that business up to Gartner standards.
Yeah, so as Neil said, Gartner started by working with chief information officers, really IT departments only. And then there were other companies that Gartner competed with. One was a company called AMR. And AMR was competing with Gartner when I was there. And the CEO told me, Gartner was too hard to compete with. And so we wanted to get into some place that wasn't a direct competitor of Gartner. So what they did is they went into supply chain. And so they basically said, well, if you can do this, if you can solve the mission critical priorities for CIOs, maybe you can do that with chief supply chain officers as well. And so they did that. And it turned out then, a few years later, we bought AMR. And so we got that supply chain business, which is how we got into supply chain. And then a couple of years after that, our current head of research actually came to me and said, hey, this was 15 years ago. So it was just when Google was getting started and when the internet was coming out. And she said, there's going to be a huge transformation in marketing. Marketing is going to go from print media to digital media, things like advertising on Google and Facebook and the like, and it's going to be transformational for marketing executives. And so we should introduce a product to serve marketing executives because they are going to be needing a lot of help to get through that transition. So in fact, we introduced a product for chief marketing officers organically from zero.
Right.
And it grew at very high rates, you can imagine, I think 20, 30% a year, because she was right. Marketers were going through this transition that was just incredible, and they had to figure out how to deal with it. And again, it's easy to say in hindsight what happened, but at the time, Google was competing with Yahoo, and it wasn't clear who was going to win there, et cetera. So marketers had a really tough job there, and so that got us into marketing. So we had IT executives liked our model, and we had great growth with that. Supply chain executives got great value out of our model. Now we showed marketing executives get great value out of our model. And we knew we could then go into other areas. And we basically said, and Neil knows this, we can grow organically for a very long time. We don't need to do any acquisitions. But we certainly do acquisitions where it's either cheaper or faster or both. And there was a company called CEB that was actually quite complementary to Gartner. They were in HR and finance and some of the other areas that we were not in. So we were, again, as I mentioned, supply chain, which they were not in. They were small in IT, and they were small in marketing. And so we could have started all that stuff organically, and we analyzed them and said, hey, that would be a good acquisition because it'll give us a real boost. It would take us 20 years to get where they were in all those function areas. And it wasn't a no-brainer because it wasn't the same business model as Gartner. So we produced this content that executives read, as I mentioned before. And then we have some conferences people could go to. That business was really built about getting the executives together with a very light piece of content, not much content at all. But they did have some expertise there. And so we bought the business for $3 billion. It was controversial with some at the time, but it got us into all these other functions. And then we introduced new products for each of these roles. So we took the basics of what they had and then new products for CHROs, CFOs, and the like. And today those businesses are all of those product lines are growing very quickly. And actually, since we bought CEB, we've gone into some other roles as well, like chief product officers, for example, chief R&D officers. And so, because each of those executives, they have really hard problems to solve and really welcome the help that they get.
Great, and I think I'll be the first to admit that it turned out to be a wonderful acquisition, despite initial skepticism. I think a lot of that has to do with yours and the team's vision, but also ability to execute against that. And clearly that's created an extreme amount of value for investors over time. So now that you address almost every role and can solve the most critical priorities, how big is Gartner's addressable market? How big is the TAM? And what is the appropriate rate of growth for the company as you go after those pieces of the TAM over time?
Yeah, so the way we think about our total market is as follows. We use various sources like Dun & Bradstreet and things like that to find out what are the potential clients we could have, and then of those clients, what executives do they have? So for example, every company has at least one CFO, at least one CIO, CHRO. Not every company has a chief supply chain officer because they may not be, like you guys probably don't have a chief supply chain officer.
We probably don't.
And so not every company has a need for a chief supply chain officer. And so if you look at the companies we've identified that are basically in the 90 countries we're in and have at least $100 million of revenue, or they are a public sector institution of comparable size, could be defense or non-defense, we then take those and sort of say, okay, if you look at all the clients we could serve with the products we have, how many are there? And just to put it in perspective, there are about 130,000 enterprises that we could serve. Today, we have one executive, at least one executive, in 15,000. So just in terms of enterprises we haven't touched yet, there's more than 100,000 enterprises. And what limits us is really how many salespeople we have. But in any event, so the way we think about our market is we have 15,000 enterprises today with at least one executive. And on average, they have more than that. They have more like 4 or 5. And then if you take the roles, et cetera, and multiply it all out at our pricing, you get a market size that's over $200 billion. I say over that, it's a lot over that, but there's no, as Neil mentioned earlier, our revenues this year will be, on the order of $6 billion. And so the market's $200 billion. Whether it's 200 or 300, we don't need to argue about. And so it's one of the unique things about Gartner is we have this huge runway in terms of the space we have. And these are all people that it's not a substitute. They're not using someone else. we have to go in and show them how we can provide value for them.
So given how big the TAM is, and if you're constrained to salespeople, how do you build your business to target, and what is the rate of growth that you think you should target, and how do you think about onboarding, hiring, and training those salespeople to achieve that rate of growth?
Yeah, so it's so our selling problem, our sales force is very good. And the reason is that they're going to C-level executives who do not tolerate mediocrity or fools, as the saying goes. They're going to C-level executives and saying, hey, Neil, you don't know what we do. We're from Gartner. You have these problems, whether it's cybersecurity or AI or whatever it might be. We can help you do it, and here's how we're going to do it. It's an intangible product with a sales force. We obviously do great at it, but when we bring people in from Gartner, it's not like some industries where you can hire somebody that's been doing it before. So just, if I think about some businesses, like investment banking, if somebody goes from one investment bank to another, there are a lot of similarities. They don't have to start from scratch. Different strategies, but they don't have to start from scratch. At Gartner, when we hire salespeople, they haven't been to someone who's doing the same thing. The most common thing is they've been doing enterprise software sales for large companies. So given that problem, it takes about 3 years for our salespeople from the time they join to the time they're at full productivity. And so what limits our growth fundamentally is the faster we grow, the more people we have in their first or second year where their productivity is lower, right, which hurts our margins. But as importantly, the higher proportion of new people you have, the less operationally effective you are. Like any business, a lot of our salespeople learn from mentoring from others. I mean, we have a lot of structured training. We use AI role plays, but you still have a lot of mentoring and training in terms of how to actually sell and service our clients. And again, these are C-level executives who can't fool around. You get kind of one shot. And so it takes like 3 years to get up to speed. Because of that, if we have too many new people, we don't have enough mentors, and our operational effectiveness goes down.
Got it. Where do you tend to find salespeople? What's the deepest pool of talent that you can fish in?
So we look for people that we think have the ability to help problem solve with senior executives. And we don't find them in any one area, but we look for them. A big area for us, it's not the only one, a big one is the different kinds of software providers that you have. Because in many cases, they're going to a company explaining what the value of that software is, how they're going to actually deploy it, all that kind of stuff. And in a lot of cases, they're working with the CEO or the C-level executives. So we look with people that have that ability to do it. The other thing we do, it's important, is, I mentioned before, we sell from mid-sized companies to large to the largest in the world. And so we bring our salespeople in early career, and they're selling to smaller enterprises. Think companies that have $100 million of revenue. And so they can learn in an environment that has more, it's more forgiving. If you're the chief information officer in a company with $100 million of revenue, you don't have a staff of tens of thousands of people. You're not using the big system integrators like Accenture. And so your level of kind of help that you need is at a different level. If, on the other hand, you're the CIO of a global, chief information officer, or the CFO of a large global bank, like JP Morgan Chase, we can't send in someone that has just, joined Gartner. And so what we do is we take people, and it takes them like 3 years to get up to speed as a more junior salesperson, selling these, call it $100 million accounts, and then we move them up to billion-dollar accounts, and they do that for a few years, and then we move them up into the $10 billion, $50 billion revenue accounts.
Got it.
So there's a whole career path. In fact, we have a very, when people join Gartner, they tend to stay.
Yeah, the retention rates on salespeople is remarkable. So let's maybe talk about maybe the elephant in the room. We're at the conference, which is AI, and maybe even before we talk about Gartner, you've been a CIO, you're the CEO of a company that perhaps has more insight into AI than any other business in the world. How transformative do you think AI really will be compared to other technological shifts that you've seen through your career?
So I think AI is going to be very transformative to us. I think that the problem we have today is people expected the transformation would take 3 weeks or 3 months.
Yep.
And it's going to take 10 years or more. You think about like transitions with the internet or even the PC and things like that. It actually took quite a bit of time. And I think for whatever reason, the press, whatever, expectations have been set that there's going to be this transformation that's going to happen. And by the way, it's going to be easy. We have a lot of clients that bought for their associates, bought generic tools like ChatGPT or Microsoft Copilot, like for all their associates. And it could be a lot of it. I have a client that I work with that spent $100 million with one of these providers doing this. They gave it to all their associates, and they got 0 measurable productivity improvement, which, by the way, we told them that's what we did. And so they came and said, well, what do we do about this? And the issue is this, which is that's not how you get productivity out of these tools. The way you do it is you have to look at very specific applications and figure out how you get the leverage out of it. And I'll give you an example. I'll give you a couple of examples. And this is actually one from Gartner. So obviously sales training is very important. And so we use generative AI to get our salespeople up to speed. And the way we do it is this. We take our best salespeople, think about our top 20% of salespeople, they rotate into sales training. So when new salespeople come on board, we don't have professionals trainers train them. We actually take the people that are the best and train them. And we like to think about it as we have our jet pilots, and they train the future jet pilots, as opposed to having people that don't actually fly jets. And so in any event, so we bring them in. The problem with that is that when you start training someone to fly, or at Gartner as a salesperson, you're not teaching them to fly jets, you're teaching them to fly these little tiny planes and take off and land. And so we've done that, and it worked very well. What we're doing now is we actually have role play using AI, and this has exceeded our expectations, where we've built some Gen AI-based role play where new salespeople come in, and we know what common objections are with clients, and they practice how they handle them. So for example, when a client says, so what discount do I get? We want our salespeople to know what the answer is and have practiced it many times. You need to practice it like 7 to 10 times before you really...
That feels like an answer, a one-word answer. Done.
Yes, but you have to say why.
Right.
And so by using Gen AI, instead of using these top 20% salespeople to get people to the basics for the new people, we actually use Gen AI, which then actually gets them to a level where they're not just flying a little tiny plane, they're actually flying bigger planes, and they're ready to fly jets. And so it uses our best salespeople much better in terms of getting up to speed. And it's not cheap using it, but it's a lot more cost effective than doing it that way. So that's an example where we're using AI. And so, but if you can imagine, that's not you take one of these generic tools like ChatGPT off the shelf and say, go do it. It takes actually a lot of work and a lot of engineering and a lot of cost to get them up to speed. All the big AI applications are like that, and so it's going to be transformative, but it's going to take like, a decade or more before we start seeing giant improvements across the board. And so I think that it's going to be transformational, but it's going to be take a lot of work and a lot of investment to actually realize those.
Got it. So now let's drill down a little bit more on the impact to Gartner. You talked a little bit about how this is going to enhance or presumably enhance your sales training and therefore your sales productivity. What are the other opportunities for Gartner from AI, and how are you expecting to implement them over time?
So the biggest single opportunity for Gartner is demand from our clients. As I mentioned, we help clients solve their mission critical priorities, these C-level executives, and they're hard. And so today, every board of directors is going to their CEO and those leadership teams, those C-level executives, and saying, how do we get leverage out of AI? And so if I look, I've been at Gartner, as Neil mentioned, more than 21 years, and the level of demand we see from every function, whether it's HR, finance, in terms of how do I use AI in my function, is unprecedented. It's something like a third of all the demand across functions. So usually, finance is interested in one thing, HR is a different thing, IT is a different thing. Well, this is like a third of everything is focused on AI. And of course, it varies by role, the actual impact. And so the first thing is, it's great for us because it creates client demand, and clients get value of it. And again, we're helping clients solve their toughest problems. That's the first thing. Second thing is, people are using ChatGPT in the world. And so the way we've had our clients work in the past has been sort of like Google. So we have these tens of thousands of documents. If you're an executive, how do you find the documents that are most relevant to me? Well, we have a search function, and it works, it works well. But with ChatGPT, now our clients want to do that. And so we've introduced a product called Ask Gartner, which is a Gen AI tool that works like ChatGPT, but it's only Gartner content. And we've designed it so it does not hallucinate. And so if it doesn't know the answer, it says, I don't know the answer. In fact, we track what questions it doesn't answer, and one of the ones we got recently was, what is the meaning of life? And of course, our tool basically said, we're not equipped to answer that question.
Well, so we have 27 seconds left. So in that 27 seconds, tell us about one of the risks from AI to Gartner and how we're positioning the business to be insulated from it.
Well, I think the biggest risk is that, again, we need to be on top of the technology. I think today we are the premost authority in the world on AI. It's changing very, very rapidly, and so we need to change just as rapidly to make sure we stay on our game there. And again, AI is a third of what we do. The other 2/3, we also have to stay on our game as well. And so I think the biggest issue for us is making sure we stay on our game with content. We know it's important. It's the most important thing we do. We're a content company, and so we do it.
Great. Okay, with that, I think we have to wrap. Thank you very much.
One last thing?
Please, one last thing.
Remember, we shape the leaders who guide the world.
I like
guide the leaders
that
who shape the world.
and text the CFO with complaints. Thank you.
We wake up in the morning asking ourselves, what is the most exciting thing going on in the world? The reason why I think it's an advantage is because it allows us to approach every company, every business as investors first. From our perspective, your market cap, your geographic location, your GICS classification, these are boxes to be checked. At the end of the day, you want a company that is a high-quality company that you believe will be more valuable, significantly more valuable over long periods of time. Where it's located is less important.
The Barron approach, how is that unique?
I think what sets us apart is that we are disruptive change investors. While many of our peers focus on the path of interest rates, what the geopolitical risks are like, what the tariff regime is going to look like, we focus on disruptive change. We think that over the last few decades, disruptive change has become so pervasive that you really have to evaluate all of your investments through that disruptive lens. Change. When Amazon went public, we never owned it because we thought they could disrupt Barnes & Noble. But we thought of this concept of digitizing retail. Digitizing retail was a disruptive change. You're buying it because the addressable market was so large and because this was a visionary company with incredible culture, right, that was not afraid to fail, that was iterating fast, and that was kind of moving mountains, right? And we thought that was really exciting. They had this insatiable appetite to make the world better.
Please welcome to the stage David Barron, co-president and portfolio manager of Barron Focused Growth Fund.
Hi, welcome back from the break. This morning I have the pleasure of introducing Martin Hoffmann, the CEO of On Holding. Martin joined the company as CFO in 2013 when the business was just 3 years old and still a small startup. Since then, with Martin's help, On has grown from a niche running shoe company based on its proprietary cloud technology into a global athletic brand. It is now the fastest growing company in the industry and almost 10% the size of Nike. So how has it been able to do this? The combination of continuous product innovation, supply control, and its unique position as the industry's most premium brand has enabled it to generate strong returns on invested capital. On is now ubiquitous with its unique brand and logo and should be able to further penetrate the large athleisure market of over $400 billion. With this new light spray technology that allows it to make a shoe in just 3 minutes, the company can better control the product and make sure its performance-first motto is maintained. The company now has a path to grow further through increased attach rates of apparel, new sports, and further penetration of its distribution channels via both their own stores and enhanced partnerships with third-party providers. So to tell you more about the On story and why we believe it is the perfect Barron investment, please welcome Martin Hoffmann.
It started with a dream to remove all distractions so runners could feel free. This freedom inspired us to challenge what had come before.
The sauce, I got the recipe.
In the place, running laps with my vibe and you can't keep the pace. Head to toe while I'm dripping in style. I'm fly with $1 million smile.
time.
Thanks so much, David, for this kind introduction. Such an honor to be here. You know, New York has a very special place in the heart of On. This is the town where we first opened our first retail store. This is where we rang the bell at New York Stock Exchange back in 2021. And this is also where Hellen Obiri just won her second New York Marathon 2 weeks ago with a course record. You know, when I get asked, do you want to come to a conference, I'm really not the first person to say, sure, I'm coming. But when Ron Baron called me, I immediately said yes. And this is not only because I really like to spend time with them in their beautiful office with the amazing view of Central Park, but I think there are very few shareholders that really live the meaning of partnership like Ron and his team do. I still remember the first meeting that I had with David, Michael, Ron, and the whole team. And the special thing was that we didn't talk much about strategy and financials. Instead, there was a real interest in who are we? Who are we as humans? What is our mission? What is our why? What is our family? And over the years, we had many great conversations around many topics, but they always come back to what truly matters. And this is the people, it's the mission, and it's the culture, because ultimately, I think this is driving the long-term value of a company. And in that spirit of that first conversation, I also will not bother you with too much strategy and too much introduction into On, but I want to quickly talk about the mission and why we are here and what is driving On. When we started 15 years ago, certainly no one was waiting for another sportswear company. But when we reflect today on the last 15 years, I think the world was ready for a challenger brand that just rethinks how that industry works, that rethinks how shoes are built to make you run faster, work more comfortable, just feel better. And for us, it was always extremely clear what our company should stand for and what should be the mission of the company. And I'm sure there are all of you who are basically exercising or doing sports regularly. And I'm sure you must have had this feeling that all of a sudden your mind becomes clear. You create new ideas. You maybe start to smile. And I'm running every day because it gives me that balance. And for me, this feeling usually kicks in after 15 to 20 minutes. So it doesn't need too long to ignite the human spirit. And so for us, it was clear the mission of the company is to ignite the human spirit through movement. And so with that, we want to bring millions of people and allow them to move easier with more fun, with more pleasure. That is our why. And all of this started with a little dream, but it was already a big dream in the beginning. We had this technology with holes in the soles, and the dreams became bolder and bolder. And at On, we like to call this mindset to dream on. But to bring those dreams to life, it needs just more than boldness. And it needs more than just rethinking how you build products. It also needs a lot of discipline in executing this. And this is where people and culture come in. And one of the core non-negotiables in the culture of On is innovation and excellence. And this sounds like a polarity but it really isn't. So it's the innovation part where you really challenge the norm, where you think, hey, what can I do differently in building product that make you faster, make you run further, just give you more joy in the product. But those audacious dreams, they only come to life when you have discipline and when you bring excellence. When you bring excellence in how you interact with the customer. When you bring excellence to your brand integrity. When you bring excellence into your retail stores, into every interaction with the consumer. So this is very much at the core of our culture, and ultimately it's the people that are driving on. Now, all the great people that we're having, they have many multi-billion-dollar dreams. So how do you bring the discipline into those dreams? How do you focus on what matters? And we were born in Switzerland, so we're a Swiss brand. If you are building a brand from Switzerland, you're either building a premium brand or a luxury brand. Switzerland cannot build a mass market brand. And so for us, it was clear we want to be a premium brand, and we want to be the most premium brand in the sportswear industry. And that clarity of the strategy from day one onwards gives us a lot of discipline in taking the right priorities, in focusing on what matters, and in picking basically the right moments when those big dreams should come to life. And we feel that position of premiumness is really what sets On apart, also from many other players in our industry. And we are living in a time where we are seeing that sportswear and fashion become more and more one. So being a premium brand in that age, it's maybe more important than it was ever before. So what we are doing at On is actually very easy. We are creating products that are rooted in innovation, you can also say in performance, in design and sustainability. That's where everything starts. Now, when we are creating the products, we are thinking about who is the customer, who is the community that we want to talk to. And On was born in running. But over the years, we ventured out to talk to many other communities. Talk to tennis, talk to training, talk to outdoors. And then when it comes to what kind of products do, we started with shoes. For the first 9-10 years, we didn't do much but shoes. But over the last years, we basically developed On as a true toe-to-head company. So we went into apparel, we went into accessories. And then we are bringing the products to wherever the customer wants to go shopping. So we don't want to define that to the customer, but we are working with the best wholesale partners in every country that we are in. You can find us online, and more, you can also find us on our own retail stores, which basically always become the pinnacle of the brand presentation. So that's our business model, but in the end, really the core essence is the mission igniting the human spirit through movement, and it's the deep belief that ultimately the success of the company is not this chart, but it's the people and it's the culture behind that. So really looking forward to a good conversation. Great to be here.
Thanks so much, Martin. Really appreciate your coming all the way from Zurich to be here today. And
during earnings week.
During earnings week, I know. But that was 48 hours ago. That was easy. You guys did so well. But no, thank you so much. I guess people know about On a little bit, but they don't know a lot about you. Maybe you could just give a little bit about your background, how you met the 3 co-founders, and why you decided to join On.
Yeah, I would say before On, I had a very uneventful life. I started in consulting. I then became CFO in a retail company, so basically the 7-Eleven of Middle Europe. And that's where I hired Mark Maurer, who later became my co-CEO and partner. And so one day, Mark came to me and said, "Hey, look, good news, bad news. Bad news is I'm quitting. I want to join my friend Casper, who they just started this brand called On. The good news is they also look for a CFO you want to join as well." And so I thought, okay, I never want to be in a position where he comes back to me and says, everything was so amazing and I'm still here. Then either we go down together or this works. But I think was what in the end gave me the confidence was the meeting with the founders. And I think a lot of what we have as a culture at On today became very clear in this first meeting today. It was the first time that I was in a meeting with 3 incredibly skilled people in very different parts of business. So we have Olivier, who is a former athlete. He just loves performance, but doesn't have so many insights into business. We have David, who is a passionate brand builder, an architect, but didn't really have a connection to sport before. And we have Casper, who can just convince everyone of everything, and which is very important in the early days of a company. And
they knew each other through how to Casper.
Everyone only knew one person in it, and at the same time, so you have those individuals, and the trust that was between them was unbelievably high, which is very different to many meetings that I was in before in other companies where you have less great people that play a lot of politics and everyone wants to speak about everything. Here was absolutely clear, if David speaks about marketing, you trust. And I think that just gave me the confidence. And then, yeah, we became a team of 5, and ever since we are running the company together.
And now in July, you recently became just the sole CEO. Mark, unfortunately, left to pursue other opportunities. But has that changed at all your relationship with them, or how has it been since July and being the sole CEO?
I mean, first, I think if you spend so much time together, and Mark and I are really close friends, so of course it's quite an emotional setback that you go through, basically losing a great friend in your daily life. And then at the same time, you are fully venturing into that CEO role, which means also changing your mindset a bit away from the finance side. But the good thing is I know the company inside out, so there's not a corner of the company that we basically haven't built, which makes it very easy. But it's getting quite lonely in a CEO role. It's you realize when people enter the elevator, it's like, ooh, what's up? But I think that's one side. The other side is we were a partnership of 5, and now we are a partnership of 4, and that hasn't changed, and the relationship hasn't changed. And there is one CEO, but the founders are heavily involved, and they are heavily involved in the creation of product and brand, which makes my job much easier in bringing everything together and really driving the vision, because I know I have incredible creative and innovative talents in my back that are creating what we are selling in the future.
You've done so well in growing it the past 12 years since you've been there, to almost $4 billion of sales. I think it took Nike way longer to get to $4 billion of sales when they first started. But what do you think makes On so special and different that it was able to grow so quickly and get to that almost 10% the size of Nike today?
I think a key component is really those individual skills that you had in the founders that then basically became part of the brand. a brand like ours, and I said it in the beginning with this innovation and excellence, a brand like ours, you need to have incredibly creative talents, brand builders, marketeers, designers. And at the same time, we are shipping almost 50 million of products from A to B. And so you need a lot of people who are extremely focused on each and every step of that process. And being able to have basically already in the leadership team all the different strengths and capabilities, I think makes it very special.
You guys complement each other well.
We complement each other extremely well, and this gives us just much more press in what we are doing. And at the same time, and I feel this is unbelievably important, that what I said before, we were extremely clear from day one onwards what this company stands for. We have not changed our path. We have not changed our strategy. There were moments, but there was never a moment where we changed it. And so we were always able to follow basically that path with clarity instead of getting hung up as like, ooh, is this still the right direction? And this is also where it sometimes helps to be 5, because maybe 1 or 2 start to doubt about where we're going, but then the other 3 is like, no, we go. That's quite powerful.
Right. And then you keep mentioning innovation, and one of the key innovations I think is the new light spray technology. You can make a shoe within 3 minutes. How big could that be, and what's the potential with that product, and what other new technologies out there that you can be able to kind of increase production?
Yeah, we actually have it here. Our industry is unbelievably old-fashioned, which is also an advantage because we are usually the first industry that moves into developing markets and gives basically people work out of basically the stages that we're in before. But there was very little innovation that has happened in our industry for many, many years. A normal shoe goes through about 125 hands to be made. So I think when Ron talks to Elon later, I'm sure that the Model 3 sees less manual labor than a shoe. So we found an intern who came to us with the idea, hey, I can basically spray like from a hot cook gun around organic forms. And so we said, okay, can you make a shoe? And for 2.5 years, he and then together with an ever-growing team, we were working on the technology. So what we can do now is we can now spray a shoe within 3 minutes, fully automated. And out of that, we have set up the first production line now in Zurich. So we are producing shoes in Switzerland, one of the most expensive countries in the world. And so this is a manufacturing revolution, but at the same time, it's also a performance revolution. And basically, Hellen Obiri was running not this shoe, but the same shoe in the marathon, because it's incredibly light and it has a very great fit. And the third big element is that also our industry is not the most sustainable. And what you have here is already 75% reduced CO2 footprint of that upper material. And because it's one material, it can be fully recycled. So there are 3 big steps that are in here. And for the last, we showed it to the public during the Paris Olympics last year. And ever since, our athletes are winning with the shoes, and we continue to develop the technology, and we will bring it to market with more models in a bigger way this next year. And so let's see.
It's more than just running.
It's going to be more than just running, yes. So maybe back in the days you were thinking that your earpods looked a bit strange when you were wearing them. Today it feels very natural. I think the same will be here.
Gotcha. And then you mentioned that how much people really want to work it on. You have about 4,000 people at the firm now. You hired 700 just this year, and 200,000 applications or resumes that you went through. I mean, better chance of getting into Harvard than getting a job at On. But why do you think people want to work so much at On and be in Zurich and work there?
I mean, it's of course an unbelievable privileged situation to be in, to have so many people who want to work for us, and I think we have an incredibly talented team, and each and every conversation that I'm in is just it's like really super inspiring. And if I show up at events, I think many times I'm more a fan of the brand than I'm a part of the team, because it's just great what the team is coming up with. I think what draws that attention is, coming back to the founders and the group of us. I think many people are also attracted by who is leading the company, and especially in the creative space. Creatives want to work for the best creatives, and innovators want to work for the best innovators. I think finance people are a bit more general, but that draws many people to On. And then, of course, being a consumer brand, being probably one of the hottest brand in Europe, being located usually in super nice locations all around the world, draws a lot of people in. But really, for us, the important thing is that because we have that, we can really excel on the innovation side, we can excel on the creative side, and we can be best in class in execution. So it's great to be there, but it's also a lot of work for talent to screen 200,000 applications and find the right one. And the last and most important thing is, the culture for On is everything. And what we do is every person goes through about 7 to 8 interviews. And one of the key focus is culture. Is this a culture fit? And then does that person bring the capabilities? It's less about the experience and what you have done before, but basically, do you bring the right mindset into the company? Enough entrepreneurial vision, the athlete spirit. So it's a bit like a sports team where you need to play together, and so everyone needs to be comfortable with who is on the team. And
people tend to stay for a while. People tend to spend their careers there, or with low turnover, or how do you?
I mean, it's relatively low. But it's also it's high speed. It's a lot of intensity. We like chaos, and so you need to appreciate that, and you need to thrive in that. And it doesn't always match to everyone's part of life. And yeah.
You mentioned on Wednesday morning on your earnings call that all the cool kids are wearing Ons. I think my kids would love their Ons. They love to hear that. But what do you think? I think some of that has to do with some of the influencers and athletes that we've had with Shelton, Federer, Zendaya. How big a part are they, and how do you make sure that it's not just a fad that people are wearing now and they're not going to wear today, and that your performance first motto is maintained?
Yeah, so athletes and culture influencers are a core part of our flywheel. So how does On work? So we create the products, but we need someone to give credibility to our products. You can't say this is a great running shoe. I mean, you can, but people don't believe you. So you need athletes to validate this. And this is why athletes' wins are extremely important for that. But when you think more about lifestyle, of course you can say this is a good-looking shoe, this is a cool shoe, but the authenticity comes from who is wearing that, who is showing up in public. And this is where Zendaya, Burna Boy are incredibly important to then also speak to that customer group, to that community, which is also a younger community. But at the same time, I think the selection process to find those talents is the same as finding a team member at On. So the culture fit needs to be there. And at the same time, when we are working with them, for us this is not sponsoring. They are part of the team, and especially with athletes, I think it's super important that you are also there for them, for what's happening after their career, and do they get education? Do they build a base for what is happening once they can't run or race anymore? So many times the athletes, but also the culture influencers, they show up in our products, and then we start having a conversation. It's like, hey, let's do something together. And of course, also there, if athletes see us winning, then you get many more applications of people want to work with us. But the relationship is incredibly well, and of course.
That was one of the things I found interesting when either you get Shelton or Cavalli or Helen starts wearing the shoes and they start winning, and you see their tennis rankings, they move up the ladder a lot, and so it's either you're really good scouting, or the product is actually working. So
it's good scouting. Goes back to people. We have great people who have good insights into all the different parts. I mean, trust me, someone who works with Zendaya or Burna Boy is a very different person that works together with Helen Obiri. You speak about very different things in those meetings. So you need to have great people that live and breathe basically the different worlds that we are in. And of course, it all started, especially on the tennis side, with getting Roger into
Is he still very involved in the business?
Well, he is. We just had a nice dinner on Wednesday. Roger spends a lot of time in the office building the product, especially the tennis line, the Roger line. And I mean, that was also a moment back in 2019 that was not planned, right? He just showed up in the products. We invited him to the office, and we are all kind of the same age, so we got along very well. He spent 2 hours instead of 15 minutes in the first meeting, said afterwards, let's go to dinner together, and then it started. And I think it's always based on this, how do you work together, instead of saying, hey, can you become our brand ambassador, can we sponsor you? Now, can you become a partner, and let's build this together?
That's great. Yeah, two years ago, you came up with a plan to double our revenue by next year, and you've certainly successful at that, even more than that. Maybe go over and even after doubling, you're still growing 25% next year. What are the building blocks towards that growth, and what else do you see out there for further growth in the brand?
Yeah, we are obviously extremely happy with how we have executed on that plan. So our goal back then was to double sales or to grow with 26% every year. We had 2 years ago we had 33%. This year we are guiding to 34%. So we now expect the 3 years to grow at 30% overall, and the core belief of that plan goes back to what I said before. What is our vision? And our vision is to be the most premium global sportswear brand. Because ultimately, this is what sets us apart. This allows us not to fish in the same pond like everyone else, but really to bring customers into the brand that maybe haven't worn sneakers or sportswear-inspired apparel before. And so one big part of what we are doing is, of course, create more brand awareness. 75% of the population in the markets that we are in don't know who On is. And so there's massive opportunity there. And this is where athletes and cultural influencers help a lot. Besides that, we basically expanded how we show up in the world, and own retail became, for example, a very important part of our journey. So we didn't have retail stores until 2020, and now we are at 60 stores all around the world. And On is a truly global company. So we are in 60 countries of the world, which is also a result of building something in Switzerland, where you just have 8 million inhabitants, so that you can't build a big brand out of there without going international. Retail works extremely well. And then another building block was apparel, which is still a small part of our business, but it's a fast-growing part. It's a big growth opportunity. But you also learn that it is something very different to have a footwear company versus an apparel company. So starting from how you do product, how you design products, how you engineer products, to the sourcing, to how it shows up in the stores, everything is very different. And many people or partners who are great in selling footwear are not so great in selling apparel.
I liked how you said that you view apparel instead of more of attach rates, it's more of like a company within the company.
Yeah, it's like a second startup that we have now, yeah.
Right, but you see tons of potential. I mean, it's 8% of revenue today. Where could that be in the future?
I mean, Lulu is a 10 billion apparel company, so that's a lot of opportunity.
True. I guess we have a question on a lot of people's minds. Is about AI a little bit. How do you see benefiting from AI in the future through revenue growth or better marketing, segmentation, or cost efficiencies? How do you see that benefiting in the future?
Yeah, it's obviously super interesting time, super nerve-wracking time at the same time, because I think so much will change in how customers interact with brands, how you shop, where you shop, what is your interface, how do you search. And if you have a business where 40% of your sales is done through your e-commerce, and basically you see that this world is changing, there is a reason to become nervous. And at the same time, there's an opportunity to become extremely bullish and to say, look, we have the great people, we have so many demand to come into the company, let's make this an advantage. And where we feel the biggest shift will happen is just how individual the consumer interaction will be in the future. I mean, today you can maybe send out 10 different newsletters at the same time. In the future, I can send a different newsletter to each and every one of you. And when you come to the website, I can show you something very different each and every time. The question is, are you still coming to the website, or are you asking your agent, can you search around and find a product? So there's a lot of disruption happening, but I think ultimately
you're gonna have to partner with one of the models. Are you gonna partner with like OpenAI or?
Yeah, I mean, ideally with all of them to basically just build the press of what's happening. And then on the back-end side, for a premium brand, it's extremely important to have your demand and supply under control. So ideally, the worst thing that a premium brand can have is too much inventory, which leads to discounting. And today, all of this planning is done by humans, and I think this is where AI can help a lot. But in our industry, AI is not an efficiency game. We are a creative industry. We build brand worlds, we build emotions, and I think that always needs people. But AI will help us to become just so much better in doing that and so much individualized. But it's a big journey.
A question that's on a lot of people's minds is also about Nike's reinvigoration. How do you see the company growing through Nike's reemergence, or as they continue to invest in their brand? And can you both go? Is it a zero-sum game, or you think we can still grow the industry and take share?
I'm very much convinced that by focusing on being the most premium sportswear brand, we are setting ourselves apart. And we are not winning if we are trying to play a zero-sum game. Then we only shift things around. But our focus needs to be, as I said, to become a bigger part of our customers' lives. First we need to find more people who know On, but then we also want to extend on where do you use our products in your life. And by focusing on that and by focusing on the premium side, we are clearly differentiating us from Nike. And if we look into the last 15 years, On has not been successful because Nike wasn't. Despite where Nike is, we became successful because we have grown the overall market. And I think this is what we continue to do.
I agree with that. We're out of time, but last question. I know you're big in marathons and running. What's your favorite marathon, and what's been your best time?
Yeah, I mean, I said I run every day. I obviously have the pleasure to
what shoes do you
test a lot of shoes, which is super important to be able to talk about it and to give feedback. I ran 4 real marathons. I did 2 Ironmans. There's also a marathon involved. And the funny thing is all my 4 marathons were within 5 minutes of the time. But I think I started my first one at 28, and I ran my last one last year in New York. The time doesn't matter, but this year, most of our leadership team ran, also all our managers from the regions and commercial managers, they were all slower than I was last year. It gives me a good feeling.
Well, thank you so much. I really appreciate the time, and thank you for coming. Thank you.
Technology stocks broadly have outperformed the S&P by 8% a year for the last 10 years, and by 4.5% over the last 20 years. First of all, that makes it a very fertile ground to invest in. 2, I think we define technology really broadly. So we don't look at technology just being semiconductors and software. And I think lastly, it's the rate of innovation. Everything in this world is going to continue to change, and the rate of change is accelerating. And we get to invest against that.
The Barron approach to investing works exceptionally well in technology for a couple of reasons. The first being the Barron approach focuses on people first. You want leaders, founders who are innovators. You want the very best people. That applies to technology more than any other sector because it is constantly changing. The second reason is Barron focuses on competitive advantage. Competitive advantage today is defined as the rate of innovation. How quickly can you innovate and then scale those innovations and commercialize them?
If you look at a company like Spotify first, it's really incredible what they've done. Really, they were the originators of music subscription. We didn't have such a thing. I mean, young people may not remember this. Before we had something called a playlist, we had a mixtape. And the other thing they did was they created a premium offering. What that means is that anyone can access it for free, but to get certain aspects or certain functionality, you have to pay. So they have 700 million monthly active users now, easily going to over 1 billion in time. And they have almost 250 million people paying for that. And we think both those numbers will rise over time. And so that's a perfect example of a company that you can invest in for the long term because they keep compounding these advantages over time.
Please welcome to the stage Guy Tartakovsky, Assistant Portfolio Manager for Barron Global Opportunity Fund, Barron Durable Advantage Fund, and Barron Fifth Avenue Fund, and Co-Portfolio Manager for Barron Capital Global Durable Advantage Fund.
Thank you. So I'm excited to introduce our next guest, Shopify's president, Harley Finkelstein. For those that don't know Shopify, the company was founded in 2004 by Tobi Lütke. It IPO'd in 2015 at a valuation of $1.5 billion. And today, it is a $200 billion leading cloud-based software provider. Shopify powers commerce across multiple channels, online and brick and mortar, B2C and B2B, domestic and international. It is the second largest e-commerce player in the US. It has millions of merchants of all sizes, from the smallest entrepreneur who is just getting started to large global brands such as On Running, which was just on stage. If you've ever used the purple Shop Pay button, then you've used Shopify as a consumer. Harley joined Tobi at Shopify in 2010, and since then has been its Chief Platform Officer, Chief Operating Officer, and recently its President. Harley is an entrepreneur from childhood. He was a bar mitzvah DJ from age 13, founded his first business at 17, and was actually a customer of Shopify, being store owner number 137 on Shopify. Even today, apart from his day job, he runs Fire Belly, a high-end tea brand on Shopify, of course. Apart from his successful career, Harley has been a generous philanthropist, supporting a variety of causes from funding the Jewish Community Center in Ottawa to being on the board of Montreal's Children's Hospital. Let's all welcome Harley Finkelstein.
This isn't commerce as usual. It's business critical partnership. We are in your corner, empowering a network of the biggest, baddest brands that make commerce better for everyone.
Thank you.
How are you?
Good to see you.
Good to see you. How are you?
It was great. I got to do some business development backstage because Martin on Running is on Shopify. And I asked him if he was getting ready for Black Friday and if he had any customer support needs. And he gave me one. So I'm going to work on that right after this.
That's awesome. That's awesome. So a good place to start, I think, Barron is all about investing in people for the long term.
Yeah.
Right, so you started as an entrepreneur at a ridiculously young age, 13. Then you were living the dream of every Jewish mother. You go into law school.
Yes. Actually, there's a good joke about that. The first Jewish president at the inauguration, the Jewish president's mother is sitting next to the vice president. The vice president says, Mrs. Goldberg, aren't you proud your son is the first Jewish president? The Jewish mother says, his brother's a doctor. Which, by the way, is how my mother also would say, yeah. It was only at the IPO, which was about 10 years ago, that I think my parents finally realized that not pursuing my legal career and joining Toby and building Shopify turned out to be a good thing. But wow, this talk is already starting unhinged, so let's keep going.
So maybe let's start there. Let's just, I'm curious, what made you successful? Like, what is this entrepreneurship that you started with and kind of continued with? What kind of got you to today?
It's a good question. I mean, look, I think there's two different types of entrepreneurs. There's entrepreneurs that are entrepreneurs by necessity, and there's entrepreneurs that are entrepreneurs by passion. The DJ thing was simple. I wanted to be a DJ. Nobody would hire me. And my dad said, why don't you start your own DJ company and hire yourself? So obviously that was very much passion-based. When I started college in 2001, I was at McGill University in Canada. My dad wasn't around anymore. I had to support my mom and much younger sisters, and I ended up starting a t-shirt company that led me eventually to Shopify. That was entrepreneurship by necessity. I had to help my mom pay for bills, and my sisters are much younger. So I think ultimately, people come to entrepreneurship for different reasons. In fact, if you think about a place like New York City, which has so much entrepreneurial energy, I think one of the reasons that you have that is because this is a city of immigrants. And for a lot of us, my father was an immigrant as well, entrepreneurship is something you do when you have no other choice. Now we talk about entrepreneurship as being, there's a glory in it. It is exciting. People live stream their journeys and talk about their failures. But for a lot of our parents and grandparents in the crowd, they became small business owners because no one would hire them. No one would give them a chance. So I think having that tool in your tool belt called entrepreneurship to solve problems has always been something that I've always had. And part of the reason that I ended up joining Toby almost 2 decades ago and committing my entire life to helping him build Shopify is I'd never found anything quite like Shopify from the perspective of someone or a tool that was creating more entrepreneurs on a more regular basis. Everyone likes to talk about, the democratization of entrepreneurship or, leveling the playing field. When you think about Shopify today, we're about 12% of US e-commerce. And I often on earnings calls will talk about, On Running or Estee Lauder or, companies that have joined us, Mattel. But actually the stories that we love talking about the most are the ones that these homegrown success stories. Sure. These stories that people started their mom's kitchen table because they had to or because they wanted to. And over the course of 10 years have now become billion-dollar companies. They're vertical leaders. That velocity of entrepreneurial success I think is very, very modern. We didn't, it used to take decades to build multi-billion-dollar companies. Even Ben Francis built Gymshark in 10 years. Gymshark now competes with Nike. I mean, I'm not in the Nike board meetings, but I suspect there are board meetings where someone in that meeting says, wait a second, what about Gymshark? That was just built by some kid in London, in 2014. And So there is this interesting thing happening in entrepreneurship now where when you give people that deeply care or need to care the tools to build something incredible, they do so. And I think in many ways this is sort of the glory age of entrepreneurship.
That's great. I mean, just to maybe set the stage here for everyone, let's go back in time, right? Let's go back in time to the early days of Shopify. What was there before Shopify? What did you guys do to kind of make life so much easier for entrepreneurs? So kind of to get us here today.
Well, you have to understand like how Shopify started. I mean, we didn't set out to build a publicly traded multi-billion-dollar software company. In 2004, Toby moves from Germany to Canada because the only reason he moved to Canada, he met a girl. So he moves to Ottawa because he met a girl, and he wants to get a job. No one will hire him because he's a new immigrant, doesn't have his working papers. So he decides he's going to start selling snowboards on the internet. Very cold, he loves to snowboard. And at the time, in 2004, there were sort of two ways to sell something online. You either sold on a marketplace like eBay, or you had to pay a company like, I kid you not, like IBM to build you an online store. And that was very, very expensive. And so Toby, being this brilliant programmer, said, I'm just going to write the software to sell these snowboards. And he called the snowboard company Snow Devil, and he started selling snowboards. And very quickly, he realized that while the snowboard company may be a good idea, the software behind it may be a great idea. And that's when I met him. I moved to Ottawa to go to law school, and not to become a lawyer, actually, just to become a better entrepreneur. A mentor of mine was teaching law at the University of Ottawa at the time. And I met him and heard his story about how he was trying to make it easy for anyone with an idea to build something online. So ultimately, I think the reason that Shopify was started and the reason Shopify has been successful is this idea that you don't have to have a lot of money and you don't have to have a lot of experience to build a business. If you think about the history of commerce or the history of business generally, the main ingredient to starting a business was always capital. You had to have money or you had to have connections. And this piece of software that, frankly, is kind of magical that Toby had built ultimately made it so that you didn't have to have a lot of money or had a lot of connections. And he made it very simple. So the idea that you can get started in a matter of an hour or two, build an online store, but then as you grow, there is no graduation, there is no ceiling in terms of the capacity of what you can do on Shopify, I think made it really, really unique. And so in the early days, it was really just small businesses building e-commerce businesses on Shopify, e-commerce stores on Shopify. And then over time, businesses got really big. I mean, some of them got to be $1 billion business, and they weren't leaving Shopify. They were staying with us indefinitely. And that allowed us to begin to think about this idea of, can we also help existing businesses, incredible brands like On Running, or like Alo, or Viore, or Birkenstocks, or Mattel, or Hunter Douglas also use Shopify. And obviously more recently, you've heard us talk a little bit about, if you're following our story, that we actually think the future of retail is retail everywhere, on every surface area, online, offline, on agentic, at a pop-up store, on Roblox and YouTube and Instagram. And so more recently, we're really becoming the company that allows you to sell something to anyone, anywhere.
Let's talk about, fast forward 10 years, you go public 2015 at $1.5 billion, and then you do something extremely rare in the public markets. You become a 100-bagger. Right? If you look today, you're a roughly
I don't use that term, but
$200 billion company. It's incredible. I mean, what would you say? I think the biggest kind of another thing you guys always talk about is that when Toby used to go and kind of pitch the idea, everyone would tell him the dam is limited. There's not many companies out there. But you were able to accelerate entrepreneurship. So talk about that, maybe about accelerating entrepreneurship, about what enabled you to do that? What enabled you to become that, very, very successful?
So 42 quarters ago, we went public on the New York Stock Exchange. We're now on NASDAQ, but initially we were on the New York Stock Exchange. And we did the roadshow. We did, it was 93 meetings. I love the roadshow. I love the IPO process. Toby, of course, didn't like it as much. He's much more reserved, introverted, cerebral than me, but I love telling incredible stories of Shopify. So I love the process, but you're absolutely right. The number one question we got on the roadshow was, what is your TAM? What is your total addressable market? And initially, we had a good answer, which is like, if you look at retail SMBs in the English-speaking world, I think there's like 60 million of them. We have 100,000 of them. We have a lot of room to grow. But actually, I think that question missed what our ambition was, which was, Not only can we grow our piece of the pie, we can grow the pie itself. So here's something that we often don't talk about, but it's my favorite stat and data point of Shopify. Every 26 seconds, a brand new entrepreneur gets their first sale on Shopify. Every 26 seconds. So there's been, I don't know, we've been up for 6 minutes, like there's been 12 or 15 new entrepreneurs that created a business while I've been on stage today. Not all of them will succeed, but the ones that do will, one, offset the costs of those that don't for us, and second, they may be the biggest merchants on Shopify in 10 years from now. So we think the pie is a fairly large pie. I mean, it is, if any of you have bought something online from a traditional retailer, you know that the experience is still not very good. So we can help get a lot larger retailers on. I spent last night with Stefan, the CEO of Estee Lauder. We just announced that Estee Lauder is bringing all their brands to Shopify. So we can help there. We can also help small businesses, to grow. But this idea that new businesses are being created on Shopify means, in some ways, we're sort of back black swan farming. And, the Allos and the Vioris of 10 years from now are getting started on Shopify now. So we've sort of been able to scale vertically from the smallest of businesses to the largest of companies. But we've also realized that if you were to pretend for just one moment that Shopify was a single retailer, so if you were to combine the million stores on Shopify, we would be the second largest online retailer in America. Why is that important? Well, the second largest online retailer in America is entitled to incredible economies of scale. Payments, shipping, capital, advertising, all these economies of scale that, the largest retailer in America is Amazon. Amazon gets massive economies of scale, of course. So what we're able to do is we're able to capture those economies of scale and give them to those millions of stores on Shopify. And so we look horizontally around what else can we do? We can do payments, we can give them capital, we can help them with advertising, we can help them with shipping. So over time, what started as Shopify is my e-commerce provider has turned into Shopify is my retail operating system. They're the most important piece of software that we use. And for the most part, when people become successful on Shopify, they never leave. And that's a big part of, I think, why we've done quite well since the IPO.
I mean, it's incredible. And I think one of the biggest things kind of tying to that point is the competitive advantages that you have over others, right? Because you have this aggregated scale and you're able to use the scale to benefit your merchants, right? You have this transaction level data on, what people buy, where they buy, to when. You're able to then use that data to help make your merchants successful. So maybe talk about kind of the importance of building this platform, building this aggregation, and how that enables you to become so much more successful. I think you said in your last Analyst Day that your win-loss ratios were between 26 and 43-1 in various segments. What enables you to think? What are the keys to that?
In different segments, it's different. I mean, at the smallest level, we want anyone that has an idea in the shower in the morning to get out of the shower and set up an online store. So for that particular demographic, simplicity is the most important thing. It needs to be as easy as checking their email. And so the product is very simple to get started. But as they scale, the complexity almost reveals itself over time. So if you are Estee Lauder, for example, you have ERPs, you have third-party logistics companies integrated, you have these massive financial systems you have to integrate as well. So the interesting part is that as you kind of grow in Shopify, the feature and the functionality set reveals itself at the right time. So that's obviously very important. But on the platform side, one of the things we realize is that, especially as retail is changing, and it's kind of remarkable. I mean, even if we were on stage 5 years ago, we would be talking about retail in two buckets. We would say there's online retail and offline retail. And currently in the US, e-commerce as a percentage of total retail is approximately 18%. It's about 25% in the UK, about 16% in Canada. So generally, even though we all know e-commerce being very large, it's still very small relative to the entire retail market. We also believe that as part of that, merchants in the future will want to sell wherever their consumers might be. And so one of the reasons that you hear a lot on the earnings call or an investor day that I talk about, Roblox decides they want to integrate commerce, and we become the commerce partner for Roblox. Or Instagram decides they want to have commerce built in there, and we're the launch partner there. Or more recently, with OpenAI, we announced that we're going to be their partner for Agentic. We believe that there is a chance that in the future, Websites may not be the predominant digital retail surface. It may be ChatGPT or Perplexity. It may be Roblox, or it may be YouTube. And so more and more, the way to think about Shopify is that we are almost channel agnostic. What's most important is that for the millions of stores that use Shopify, whether you're the smallest of merchants or you're Martin from On Running, wherever your consumers are spending their time, you can sell using Shopify in that particular place. And I think by doing that, one of the reasons that these companies, these big companies come to us is total cost of ownership is much lower than doing it themselves or hiring a big legacy software company. But second, it future-proofs their business so that when they are thinking about agentic and they're wondering, is agentic going to displace search commerce, meaning go to a search engine, type in sneakers, and they're worried about that, they can rely on the fact that their retail operating system, being Shopify, will future-proof them for that existence. Now, look, is agentic going to be like the primary digital commerce destination? We don't know. Our job, though, is whatever permutation does exist, that Shopify and our merchants are best positioned. I mean, social commerce, 2 years ago on stage, we would have been talking about Instagram commerce being this massive new opportunity. It turns out that most of us that are using Instagram, we use it for discovery of new brands, but very few people are checking out on Instagram. They're going to the online store to check out. So, you know, we placed a bet there to say if Instagram becomes the default place people shop, we're going to be there. I think agentic actually has a lot more opportunity because I think it has more context. But I think that's the reason why so many brands are coming to us. It's incredible cost, incredible simplicity, great scalability, and it allows you to say wherever commerce is going, Shopify will be there.
So let's talk more about agentic, right? Obviously, we've seen so much disruption over the years in commerce, right? From small local stores to department stores to specialized discounters to online marketplaces to multi-commerce, multi-channel. What do you think agentic means? If we sit here in 5 years, right, and talk about what is commerce, what does AI do for commerce?
Let's take it from two different vantage points. First, I think, is what it does for companies like Shopify. So here's a quick example. We built a product called Scout. It's an internal product. Scout effectively, it's an MCP, but it allows every interaction Shopify has with any merchant to be fully cataloged and organized. So now anyone at the company, we're about 8,000 people, anyone at Shopify can literally say, I want to know how our capital business how merchants that use our capital business in Western Europe are using it and how they feel about it. And what used to take weeks of data and meetings, we can get in seconds.
So product acceleration, basically.
Exactly. And the feedback loop is so tight that we can know exactly what is happening in any geography, at any band, for any product immediately. So we have a bunch of those products inside of Shopify that's making us operate at a much higher velocity than ever before. For our merchants, we have built something called Sidekick. And Sidekick is effectively, the reason we call it Sidekick is, every superhero needs a sidekick. This idea that every single merchant on Shopify, whether they're large like On Running or they're two people in a garage, they have this tool available to them that knows everything about their business and everything about Shopify. And they can do product descriptions, or they can take help with product photography, or they can do analytics and reporting, or they can figure out where to actually place bets from an advertising perspective. Then there's, of course, the other side of it, which is the consumer. More and more consumers are spending time using these chatbots, these agentic applications, whether it's Perplexity or ChatGPT or Microsoft Copilot or Gemini. And one of the things we see happening is that more and more consumers will begin to talk to their chatbot about what they require from a shopping perspective. For example, I have two daughters. My 9-year-old is right now obsessed with something called K-pop Demon Hunters. She's having, if you guys have kids, it's a big deal right now. So I can go onto any of these agentic tools and I can type in, Bailey's birthday is coming up. I want to have a K-pop Demon Hunter birthday party. What should I buy? And it'll peruse all of Shopify's catalog and send to me, you should buy this, these napkins and these balloons, and you should buy these decorations, and you should buy these games. And I can check out right there in the chat itself. And the way that we've done it is we've built these tools that allow any application, any agentic application, to plug it in. We have Catalog, which takes all of the products on Shopify. We have a checkout kit, which allows them to customize the checkout. And then we have Universal Cart, which means you can have one single checkout across multiple stores. And again, it all happens when you're in your own personal assistant. That is something that historically, as you know, I didn't grow up with a lot of money, but I know that rich people have personal shoppers. Well, now like the whole world gets personal shoppers, and the personal shopper is not on commission, which means they can show you objectively the best products relative to your entire search history. So there is a real chance that agentic commerce will become a new major surface area for consumers to spend their time. And our job is to make sure that if you're on Shopify, you are better prepared than if you're not. And again, whatever permutation happens, we think we're really well positioned for that.
Do you think agentic has a chance to accelerate e-commerce penetration? Because if someone would, let's say they want to browse, they would have to go to the store, right, to the brick and mortar store and browse. There's really no great way to do it online. Do you think that?
That is a very good question. Okay, so back to the whole, 20% or 18% of retail is online, the rest of it is done offline. Will it accelerate? There's been a couple, I've been working with Toby at Shopify for about half my life, almost 2 decades now. And there's been a couple times where we've noticed that things have really changed. So, 2008, things really changed. Obviously, the global financial crisis, more people started to become entrepreneurs because they wanted to offset job losses or losing some of their salary. The pandemic, we saw this massive acceleration. There is a chance that agentic does that same acceleration as well. We don't know for sure yet, but those people that are currently not buying online because it's complicated or it's intimidating, it's a lot less intimidating when you're talking to a chatbot who fundamentally knows everything about you. And the chatbot is not going to show you random stores that end up paying, for that ad. They're going to show you the most highly contextualized result. And so if you love On Running like I do, and you've been searching for On Running, and you're planning to go on a hiking trip, it's going to show you On Running hiking boots, not some random hiking boots because they paid more. And I think that has the chance to invite more people to participate in modern retail that otherwise have not.
So you increase conversion rates.
Correct. And also you increase the TAM of e-commerce generally.
Yep, incredible. I think another kind of interesting point which ties to what we discussed earlier is, again, you have all of this data, you have this aggregated scale from all of the small merchants that you have, and the merchants have always had this problem of customer acquisition. So talk about maybe how you need to evolve or what you can offer merchants in terms of helping them acquire customers in this new world.
Well, I mean, this is where the data piece plays a real role, both agentic, but also just for advertising. We can make things really easy for merchants on Shopify, but there's a couple things that they still have to do that historically have to do on their own. The first is manufacturing. We don't do manufacturing, they do that on their own. But the second is customer acquisition or advertising. And one of the things we've been working on is shop campaigns, which effectively is a new way for businesses of all sizes to advertise. And the way that shop campaigns works, it's really elegant. All you do is you say, here's what I want to spend on an ad, because based on my price, my customer lifetime value, this is what I can afford to spend. And then we, on your behalf, go and buy those ads for you on Shop, but also on other surface areas as well. Because we have so much information, because we have millions of stores and billions of transactions, in Q3 of this year, if you heard the earnings call, we did about $91 billion of GMV. We've done over $1 trillion collectively on the platform, but about $91 billion in Q3. Because of that, we just see more. Therefore, we can say to our merchants, if you're placing an ad for this type of product, we think this type of product description is the highest converting. We think this type of product photography is the one that consumers are looking for. We think this type of pricing could make sense. Like, here's the cheat code for placing ads. It doesn't guarantee that they're going to have customers, but it does reduce the friction and the risk when you are placing ads. And we've done that across, advertising is an exciting one, maybe one that's less boring, but something that I really love is our capital business. Most of the businesses on Shopify cannot go to a bank and take a loan. It's just that banks don't lend to direct-to-consumer sneaker companies readily. But because we have so much information, we can do this incredible, we can do underwriting in real time that says, given everything we know about your business, and we know a lot about your business, we can give you this cash advance.
Who's successful?
And in a matter of seconds, you'll have it. And then we'll simply recover as you sell more over time. So that is sort of where, in an era where the businesses with the most amount of data are going to be able to have the most amount of leverage and opportunities. That's where we think Shopify is a real opportunity in the future. And ultimately, our business model, unlike a lot of retailers, our business model is very simple. If merchants sell more, we make more. If they sell less, we make less. And I think because we sit on the same side of the table as the people who use our product, it creates a different dynamic where it doesn't feel as if, you know, there's like we're taking something from them. It feels like we share in their upside if there is upside.
Yeah, it's a huge, I think, competitive mode for you guys.
Definitely, yeah.
For sure. Maybe touch a little bit, so Toby published a memo, I think a few months ago, about being AI first company.
It was an internal memo that got leaked, but yes.
Yes.
Published a memo.
What does it mean in practice? What does it mean being an AI first company?
I think every company right now generally is talking about AI. And some of them are doing it because everyone else is doing it, but there are a few companies who really see this as this paradigm shift whereby everything you do at your business can be operated with higher efficiency, higher effectiveness. And Toby's memo was written because he wanted, and I think I think we're there now. He wants Shopify to be what he calls reflexively an AI company. And that doesn't just mean that developers use these incredible developer tools to write better code faster. You know, Jeff Hoffmeister, who you may know is our CFO, an amazing CFO, when we were preparing 2 weeks ago for our earnings call, the process that we use to prepare for earnings is we meet every team to get sort of their highlights and their lowlights, but we want to know what they're excited about. For the last 3 earnings calls, Jeff and I have had very different conversations with their teams because before we even sat down with them, we already had a full understanding of what each team was doing because we've made Shopify incredibly legible. So the reason that I think Shopify has become reflexive is it isn't just that the engineering team or the finance team is using it. You see teams across, I mean, we just opened a new office here in New York, in Chelsea Market, and I had breakfast with our real estate team. It's incredible to see how our real estate team is mapping, using AI, where our employees live, proximate to where we should build an office. The reason we're in Chelsea Market and we're not in Soho anymore is because we were cutting down a real percentage, a meaningful percentage of commute time from so many of our people that work there. That could have been done without AI. It would have taken months. It took them less than a day. So that's what Toby means. He wants Shopify to be a company that uses AI as a reflexive, first step. What that memo also suggested, which I think this is the reason why it leaked, was he also told the company, before you hire anyone new, please substantiate to us why AI cannot do it. And that sounds like a process, but actually it completely changed the way our team thinks about things because often what we'll see is while they're substantiating why they need to hire someone instead of AI, they have this like epiphany of like, oh right, I actually can't use AI for that. And it changes the dynamic, and so this is public record, we've kept headcount flat for the last 9 quarters or so, even though our revenue has grown upwards of 25%, 18% free cash flow margin. Our GMV was upwards of 30% year on year this past quarter. So the company is growing so incredibly well on a flat headcount. Why is that happening? It's because we're adding incredible tooling to that headcount, which makes them so much more efficient.
Let's talk about growth. It's incredible. You started with really helping small entrepreneurs. Over the years, you were able to maintain that, further make it easier for new businesses getting started. But now you're also selling international. You're also getting the largest brand. You just announced Estée Lauder, on the earnings call. Where do you see the biggest opportunities for you guys over the next, and again, we're all about the long term, over the next 5 to 10 years?
There's a few real growth levers that are really exciting. Personally, the one that I'm most involved with now is I think that there are still so many incredible brands and retailers around the world who have been around. Birkenstock was created in 1776, Hunter Douglas 1919, Mattel was created in 1945. These are iconic brands, and now these iconic brands have this incredibly modern, beautiful, delightful e-commerce stack. but there's so many other brands that exist out there. I'm not going to name them right now. It might be a little bit embarrassing for them. But there's still so many of these large companies who don't have a good modern retail experience online. And so that to me is like, it's not low-hanging fruit, but I want more of those larger brands, larger businesses to come to Shopify. Selfishly, it's great for the business, but also because I think there is an opportunity for them to actually have another step function in their journey, in their story. When we were with the Estee Lauder family, I got a chance to meet the Lauder family. Like, they really care about this that's a 4th generation company. I spent some time with Canada Goose recently, who's coming to Shopify now. That's a 3rd generation company. Incredible product. It needs to have an incredible shopping experience. So enterprise is a big one. International is a big one too. We have been really focused on the sort of core English-speaking world for Shopify. I mentioned that in the United States, about 18% of all retail is online. In places like France and Germany, it's much lower than that. UK is actually higher, it's at 25%, but Europe's a huge opportunity. APAC's a huge opportunity. I mean, the brands we're seeing from Japan that historically only sold domestically, but now have global businesses because of Shopify, I think international is an incredible opportunity. Maybe the third one is sort of less sexy, but important, is POS, physical retail. I think we've done a good job of telling the world that we are an e-commerce or a digital commerce company, but I think our point-of-sale product is the best in the world right now.
I mean, it's incredible. You're growing that at 30%.
Exactly.
Where, obviously offline commerce doesn't grow that fast.
And we're tourists to that industry. I mean, you walk into stores all over. I spent the night in Soho last night, and Soho is like literally Shopify row. Everywhere you go, it's a Shopify store. So I got a chance to walk in, and I went into Tecovas, which makes these beautiful cowboy boots, and the store is amazing. And there's no cash register because people are walking around with their Shopify, tablet, and they're just basically checking out wherever you are. And then you walk into a department store, and it's slow, and there's a lineup, and they tell you what credit card to use, not use, and they need you. It's just the delta between modern retail in the physical world and traditional retail in the physical world is massive, and I think that's a huge opportunity. Maybe the last one I would say that I think is really exciting for us is the agentic piece. That how do we, given that there is a high likelihood chance that this becomes a very important piece of the future of retail, making sure that Shopify is so well positioned so that Shopify merchants are the ones that show up first. I would say those are sort of the 4 major growth levers.
Yeah, and I think also agentic can really accelerate and cause, many of these old school merchants say, hey, I really have to, think to the future.
Yeah, I mean, some of them are just like, they're at a board meeting and someone on the board says, how are you thinking about agentic? And they take a note and then they go tell their team, how are we thinking about agentic? And so our job is so that whatever is on that note written down, someone says, well, yeah, we're gonna look at Shopify for that because they have everything on this note.
So I guess last question for me. So a month from now, when the audience looks back at this conversation, what do you think is the single most important non-consensus thing they should understand about Shopify's opportunity and long-term positioning?
Wow, that's a good question. I think this idea that we can handle these incredible brands and products on Shopify, but also at the same time, every 26 seconds, a new business is being started, that I think should be the takeaway. Because there are not many companies that really allow you to go from like literally cradle to scale in that way. If you think of any other industry, any vertical in software, there's a natural graduation as you grow. I mean, take email marketing. As you get bigger, you sort of graduate to the next product, or accounting products, accounting software. There's this graduation. Software has always been like that, where as you get larger, you must find a new vendor, you must find a new partner. And this idea that we can help you when you're getting started, but then when you're doing many billions a year, you never have to leave the platform, that I think is incredibly important. And maybe the other thing I would say is there is this era right now, and I think Shopify is certainly, I hope, a poster child for this, these founder-led companies. That founder-led companies are just built differently. This is a technical term, but there's a give a shit factor. That I'm not joking, that founder-led companies have. There's a long-term approach to things. You've heard me talk about the 100-year company. That is real. Toby and I are spending our lives building this thing because we think this is important. And we think that ultimately, the story of Shopify should be the story of entrepreneurship at every single scale, and it's something I'm very proud of. And I like that you, the investors, are allowing these founder-led companies to grow at this pace, because there was a period of time where, at some point we would be told that some professional managers are going to come in, and I think Toby and I believe we have to requalify for our job every year. But as long as we requalify, I think it's very difficult to compete with a founder-led company because of that level of care.
And we love it.
Yeah.
Thank you so much, Harley. This is great.
an Emmy and Grammy nominee. She has starred in 12 Broadway and West End productions and 3 productions right on this very stage. She's currently starring opposite Tom Hanks in the new off-Broadway play, This World of Tomorrow, which begins performances next week. Please welcome back Kelly O'Hara.
I've heard that there's a secret chord David played and it pleased the Lord, but you don't really care for music, do ya? Well, it goes like this: the 4th, the 5th, the minor fall and the major lift, the baffled king composing hallelujah, 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 hallelujah. Your faith was strong, but you needed proof. You saw her bathing on the roof, her beauty and the moonlight overthrew you. Well, she tied you to her kitchen chair, she broke your throne and she cut your hair, and from your lips she drew the hallelujah, 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 Well, baby, I've been here before. I've seen this room and I've walked this floor. You know, I used to live alone before I knew you. And I've seen your flag on the marble arch. And love is not a victory march. It's a cold and it's a broken hallelujah. 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 Well, maybe there's a God above, but all I've ever learned from love is how to shoot somebody who outdrew you. And it's not a cry that you hear at night. It's not somebody who's seen the light. It's a cold and it's a broken hallelujah. 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 Hallelujah.
Thank you. Dan Lipton. Thank you so much. Hello again. Here's God Bless America.
While the storm clouds gather far across the sea, let us swear allegiance to a land that's free. Let us all be God bless America, land that I love. Stand beside her and guide her through the night with a light from above, from the mountains to the prairies, to the oceans white with foam. God bless America, my home, sweet home. God bless America, my home, sweet home.
Thank you. Dan Lipton on the piano. Thank you.
Really, I think back in 1982, Dad had a choice in terms of what he wanted to do with Barron Capital. Did he want to be an individual serving elite institutions, or did he want to actually build an institution that served people? And he tried to make Barron Capital as broad as possible.
The average PM has been with us for about 20 years on average. The average analyst has been about 8. People do stay with us for their careers. We have really low employee turnover. And that's one of the key things we look for in our businesses as well.
We've never just been about investing. We've always been about people, about the people that we serve, and also the people that we invest in. People who are driven, who are smart, who are ethical, that we get to know and trust and believe that they can fulfill their objectives to serve our end clients.
Please welcome to the stage Cliff Greenberg, Barron Capital Co-Chief Investment Officer and Portfolio Manager of Barron Small Cap Fund.
Thank you, everyone. Thank you very much. Welcome back, everyone. I hope you're having a great day and enjoyed the morning sessions. Yeah. It was terrific to hear from some of the executives who we invest in and the portfolio managers who oversee your funds. And how about those amazing performances at lunch? Yeah. Thank you all very much for being with us today. This conference is going strong for 32 years. It's our great pleasure to try to take you under the hood to give you a better sense of who we are and what we are investing in. We thank you for your trust in us and for sharing our belief in the power of long-term growth investing. We have a great program this afternoon. The lead analyst from Morningstar is going to interview some of our ACE portfolio managers. Michael Barron will describe some of the new initiatives we are undertaking. And then our fearless leader, Ron Barron, will share his insights. Well, I met Ron Barron some 40 years ago. After going to law school, I worked at a New York City-based investment partnership. We would visit companies together, share investment ideas, and became fast friends. I joined Barron 28 years ago in 1997. The firm was small but growing rapidly as Ron was gaining great notoriety for his stock picks. I joined to help Ron manage his funds, to start a new fund, the Barron Small Cap Fund, which I'm still overseeing, and to help build a unique and exceptional institutional investment firm. I believe we have succeeded. We now manage $45 billion in assets, have 19 strategies, a top-notch investment team of over 40 people, and a great firm with 217 employees. Ron was very convincing when he recruited me to join. He projected that the firm, which at that point was under $1 billion under management, would grow to over $20 billion in time, which seemed inconceivable. Well, we blew through that, and the new target is $200 billion. We are building a firm to accomplish this ambitious goal. Ron is a sensational investor. He has incredible vision to identify special businesses and extraordinary leadership teams. He has an insatiable drive to deeply research these businesses and understand their big opportunities. And he has a remarkable ability to stay the course and trust his beliefs. That takes courage and it takes conviction. Ron is a great business builder and leader. Baron Capital is not a great firm by accident. He built the business by carefully hiring special people, a group that is talented, hardworking, and nice. I'm so fortunate to work with them. It's a very, very special culture that we have created. He has ingrained in all of us a differentiated investment approach that has been embraced by the entire investment team, a highly skilled group that for the most part has spent their entire career at Baron. And we put the clients first and have delivered enviable investment results for our shareholders. Baron funds have superb long-term track records. Ron is also a great guy, and he's the same guy I met some 40 years ago. He is the ultimate optimist. He is a dreamer and a long-term thinker. And he's also kind of nutty and fun. Ron will kick off this afternoon with a wide-ranging conversation with Elon Musk. How about that? I'm sure it's going to be great. It's my privilege to introduce him now. Please join me in welcoming Ron Baron, my friend and yours, the founder and chief executive of Baron Capital.
Thank you, everyone. As I said before, this is a lot different than Convention Hall in Asbury Park. Today, we're privileged to have Elon Musk join us virtually, and there couldn't be anyone more appropriate to speak to today when the theme of our conference is changing lives. There's no one who's changed our lives more than Elon, especially changed our lives financially, but changed everyone else's lives, and that really feels like it's just beginning. Without him, there'd be no electric vehicles, there'd be no FASD. Has anyone ever thought of full-service self-driving 5 or 10 years ago? Has anyone ever thought about that? Reflyable rockets, no one has been able to do that before. Congratulations to Jeff Bezos for accomplishing it yesterday, first time. We've already done, 5,000 flights? And we have 9,000 satellites, I think it is, on the way to 15,000. So, and the people who did that for him, did it for Jeff, are people who used to work for SpaceX, but couldn't go fast enough for Elon, so now they went over to Bezos. So there would be no Starlink, no Refly, no Optimus. In fact, one of the first questions I wanted to ask is I was telling my assistant about Optimus before and how the plan is to go from 1 million production next year to 10 million the following year to 100 million to 1 billion. And what she asked me was, well, so where's the room for them on the sidewalks? Are you going to build something? Is that the idea that we have behind Boring Company, to go underground for the robots to walk around or fly above? Where's the room for them?
Well, actually, you can fit all of humanity on one floor in the city. That's how small the humans are. And Optimus doesn't mind being packed densely. So it's always helpful to think how much room do people take? And this is why I think just having it in the back of your mind that all 8 billion people on Earth can fit on one floor in the city of New York. So another way to think about it is if you're flying across the country and your goal is to drop a water balloon on someone below you, you will fail because it's empty.
We used to do that when we were in 8th grade. We got them though.
Yeah.
So Caitlin, don't worry, there's enough room.
Plenty of room.
So one of the things I think about when you talk about Optimus is that there's so many functions that it can perform. What's going to be left for humans? Is there a job that humans going to have other than just living in this great abundance that you're going to create? What's going to happen?
Well, I think there is this question of how do you drive meaningful life if the AI robots can do everything? But we see lots of examples where even though machines can do much better, humans still enjoy these things, like athletics, for example. Or let's take a mental sport like chess. Computers are so good that your phone, not even connected to the internet, can beat Magnus Carlsen easily. But yet, chess is at all-time highs in popularity. So, really, machines being better than us at something doesn't mean we derive satisfaction in doing it.
By the way, guys, the connection isn't that good with the phone. Is there some way we can do something else?
Bit echoey.
The connection isn't that good, I think. It keeps cutting in and out.
What if I had talked close?
Talk close? Okay, you do that, and I'll do this. So the function.
I get like that closer look at my nostrils. Sorry.
The functions that you see these robots doing is what? What are they going to do? And why is that? How are we going to have 1 billion of them when we have 8 billion people?
Look, it's going to take us a minute to make 1 billion robots, so they'll all do various things. But I think we will. There will ultimately be billions of humanoid robots on Earth. A way to think of it is, who on Earth would not want their own personal R2-D2 C-3PO? Like pretty much everyone wants, C-3PO, but even better. Like your personal helper buddy robot, it would be great. You could teach your kids, take your dog for a walk, get the groceries, chat, protect you when needed. Great. And then how many robots would there be in industry providing products and services? Probably 3 or 4 to 1 relative to humans. Which suggests that total number of robots will be somewhere around maybe as high as 40 billion, maybe 30 billion robots. It's a lot.
So the Japanese company, I think it's KUKA, those robots that are used in manufacturing are 50,000, 100,000, 150,000 and you're describing a robot that's $20,000. Do we have to have $1 million a year to do that, or $10 million a year to get to $20,000? And is that something that's going to be affordable for people? Are they going to be rented? Are they going to be purchased? Corporations, are we going to get some kind of carried interest once they buy them from us? How is this going to work? Or don't we have the model yet?
My rough guess is that the cost of goods sold, their labor and materials for Optimus, after we reach 1 million units of steady state production, so call it a year after reaching 1 million units a year, because it takes a lot of effort to improve the cost. But at that point, I would expect the labor and materials to be $20,000 to $30,000 in current year dollars. I think that's a pretty safe estimate.
When you're improving costs, so with cars, your idea is that everything we buy from other people to use in our cars, we know exactly how much it costs. And therefore, we can tell someone how much we're going to pay for what we're buying from them. And if they're making too much, then we make that stuff ourselves. Is that the same kind of idea we have in this robots, where it should be much simpler to make than a car? Or am I wrong? Because of the hand.
The hand is extremely complex. There are 50 actuators in the hand and forearm.
Actuator is the motor?
Yeah, actuator is the motor, gearbox, and power electronics. So that's 100 per robot. Really, a lot of actuators and sensors. Right? Am I getting that right? Approximately. So there's a lot of complexity.
Why is that important? Why is it important that we have such a complex hand?
So in order to do dexterous tasks, you have to have a hand with the sensitivity, precision, and degrees of freedom of a human hand. Because so something that we find easy to do, like pick up a screwdriver or turn a wrench, or even say thread a needle or play the guitar, actually require a lot of dexterity. One of the reasons we think we can achieve sustainable abundance, which is sort of the new sort of the revised version of the company's goal, because it was accelerate sustainable energy, which, as you mentioned, we've done that. Our new goal is sustainable abundance. So that's abundance for all, but in a way that is sustainable, that does not destroy any of the natural wilderness.
How do we decide who gets what? Somebody wants to buy my house, they can just come in and start living there?
Well, I'm not sure why. I mean, you do have a nice house, so I can certainly see the appeal. But the robots will be able to make anyone a house, and as long as you don't insist on it being in a particular location, you can have robots will be able to build you a castle if you want. So. But the reason for hand dexterity is you want to be able to do like surgery and precision medical actions. And so imagine a world where everyone has access to the best surgeons, literally everyone. And Optimus will have a level of precision that is frankly superhuman, and will be able to do medical procedures, of very sophisticated medical procedures, any medical procedure, perhaps things that really humans can't even do because they're too difficult, and that will be available to anyone. People often talk about eliminating poverty and providing great medical care, but they never actually have a solution. and money doesn't solve it because there are only so many, there's a very limited number of great doctors and surgeons. They don't grow on trees. But now they'll get built in factories.
So I sent you a year or two ago an article about a young man who was in an interview in Barron's, and he was 33 at the time, and he'd become a portfolio manager, and he lost his legs to he was a Paralympic performer, and he lost his legs to man-eating bacteria. And he said, is there anything we can do to get him out of the wheelchair? And you said, yes, there is. In 3 or 4 years, we can give him an Optimus body, and then we can use transistors in his head, in his brain, to let him function as a normal person, dance and sing and walk and run. Have we been able to make progress in that area?
Yeah, so that's a confluence of two of my companies. One is being Neuralink, and the other being Tesla. So Neuralink is also making good progress. Now has, I think, over 10 patients with Neuralink implants. And these people who didn't have the ability to move their arms or legs, in some cases, were completely locked in, like Stephen Hawking. And they can now communicate, I think, as quickly, or almost as quickly as we're communicating right now, which is very cool. And that's going to continue to accelerate. So what we can do is use a Neuralink implant that is taking signals from the motor cortex of the brain, and also receiving signals from the somatosensory cortex, and then give someone who's lost their legs Optimus legs. And so I mean, we're really getting like the $6 million man here. I mean, from back in the day. I don't know if you watched that show, but I watched it.
I watched it.
Yeah, I thought it was pretty fun.
Yeah.
You know? And we can actually give someone superhuman cyborg capabilities, like the $6 million man, for less than $6 million. Even in this day and age. I mean, $6 million back then was a fortune. These days, it's like nothing. But for much less than that, I mean, like for something that would be reasonable and affordable, you know, it might be more like $60,000 type of thing. And you can take the signals from the Neuralink in the mind that would be transmitting to the legs and transmit those to the attached Optimus robot legs. And he would actually be able to run faster than a human. Just like $6 million man.
Your Neuralink sounds really exciting. Sounds unbelievably exciting. Let's switch to XAI. So 3 years ago, you were here, and you had either just purchased or about to purchase, Twitter, which you've renamed X, and you were widely criticized for that. And
yes, it was.
Right. In fact, you even mentioned here on stage that you didn't want to have anyone else be angry at you because you had enough people trying to kill you already.
Yeah, totally.
Right? So you were buying X, and it was $42 billion, I think, and you were in the process of raising money, and I called you up, and you hadn't called me to solicit me, and I called you up, and I said, I would like to invest with you $100 million in this, and it was $60 million for one of our funds and $40 million for me, and you said, really? I said, yeah. You said, really? And I said, yeah. And you told me that you thought I would make a double. And I said, well, I hope so. But to me, it felt like you made us $8 billion in Tesla, and it'd be not very appropriate if I didn't support this new venture that you were doing. So we invested. And then the day that we paid the money, we marked it down 70%. So
oh man, this is how I know you're a true friend, Ron, because this is I do regard you as a true and trusted friend, and you know the test of friendship.
I got more to the story.
Well,
it's a better ending.
The test of friendship is who supports you when the chips are down and the times are tough and everyone's against you, That's a real friend, and that's you, Ron.
Thank you. So we did invest that 100, marked down to 30, and then about a year later, we started getting phone calls from hedge funds who always seem to know things we're not supposed to know.
Yeah, how do they do that?
Right? And they started saying, I'd like to buy your stock for what you paid for it. And I said, I think I'd rather wait and stay in, which I did. And then changed the name to X and changed the configuration of the business. And then from that, you bought Twitter, and it came together in a social network along with this. And all of a sudden, we have a business that has incredible data. Did you buy this for the data that no one knew about? But the data with 600 million people talking with each other. So physical data that no one else has. And then you started Grok, which is based on our data. And everyone else doesn't have that. They got digital stuff. And then when they have Grok, then we need more data centers. And you're building those. And in a space of a very short time, less than months, you built a data center which is 4 times what is large as anyone else on the planet, 25,000 what other people had in CPUs, and we built it in GPUs, 100,000 more powerful. And then, now we're going to go to hundreds of thousands. But the bottom line is the investment that we made, we put up more money, and we have a total of $350 million invested over the past 2 or 3 years, and now it's worth $700 million. So everything you touch is like that. It's the most unbelievable thing I've ever seen. So everyone is investing in technology, and we are investing in the technology person, the best engineer on the planet. So thank you very much. So the vision is, the question is, did you buy X? Did you buy Twitter because of the data? Did you have all this in your head before you did it?
Not really, no. I just bought Twitter because I thought it was having a negative effect on civilization, and just sort of pushing ideas that were anti-civilizational. It's sort of has been somewhat captured by the far left. That's it's fair to say the radical left. I mean, they wouldn't regard themselves as such, but it was captured by a group of people whose political beliefs are those of deeply San Francisco and Berkeley, which is about as left as you get in America. So that meant it wasn't a good forum for debate, because they suspended many people on the right, including the president, as you may recall, a sitting president, which is really unprecedented for precedent. So I think we need to have a public square where there's true freedom of speech, and freedom of speech is. Freedom of speech is the bedrock of democracy. If there's not freedom of speech, people cannot make an informed vote. And if you cannot make an informed vote, you don't have a real democracy. So that's the purpose of acquiring Twitter, was to try to bring it more to the center. There have been no left-wing voices have been banned or anything like that, or suppressed. But what we're trying to do is give equal weight to all parts of the country, so that there can be a public town square where people can exchange ideas and hopefully not resort to violence. And I think that's fundamental to. I think it's one of the. Like I said, free speech is the bedrock of democracy. It's why it's the First Amendment, because people came from countries where if they could be killed or imprisoned for what they said. And in fact, this is happening all around the world as we speak, even in places like Britain. So that's anyway. I did it because I felt like if the civilizational risk had to be addressed. And I mean, if America is not strong, then what do businesses matter? America is the central pillar that holds up a Western civilization. And if that pillar falls, everything falls.
So you were one of the founders, the two founders of ChatGPT and OpenAI, and you had a disagreement, and it was founded as a charity, and it was your idea that you wanted to make sure that freedom of speech and all the things that you deem important for good lives on our planet were followed, safety. And the other founder, what he tried to do and did, was accomplished, is that he got control, even though it was your money, and he got control, and he said, Elon, I'd like you to stay, and you said, I want to go, I don't want to be a part of this, and he offered you some ownership, and you said, I don't want it. And so here, you walk away from an ownership of ChatGPT. So you're obviously not doing all this stuff for money. I mean, you are, but I mean, that's not. But I mean, if it were only about money, you would have never left something that's worth $500 billion by itself. And so here, you're forming this new entity, Grok, to accomplish what you wanted ChatGPT to accomplish, but you think that we have an advantage in this because of the data, because of the compute, because of what? And what are you going to do with this ultimately? So you talk about connecting physical world to digital. What does that mean?
Yeah, well, just going back to OpenAI for a second. The reason I founded OpenAI was because I was concerned, based on my conversations with Larry Page, who used to be a close friend of mine, that he was not sufficiently concerned about the dangers of AI. This really came to a head when, at my birthday party, he, in front of a large group of people, called me a speciesist for favoring humanity over computers. I found that troubling. I was like, Larry, what side are you on? It sounds like you're on the side of the computers, but you really need to be on Team Humanity here, So after that, I was like, okay, this is it. We got to have some counterbalance to Google, because Larry doesn't seem to care if humans make it or not. So I thought, what's the opposite of Google? It would be an open source nonprofit. And that's where the word open in OpenAI comes from. It means open source. And I provided all the money, beginning, like whatever the Series A, B, C rounds, and recruited the key people like Ilya Sutskever, and taught them everything I know. And I actually even got them to deal with Microsoft, with Satya initially. I got Satya to donate some time from Azure. And for all that, I did not seek any financial reward whatsoever. And the reason I actually turned down the offer for shares is because, I felt like, what do you, shares in what? Like, nonprofits aren't supposed to have shares. At least last time I checked. They're not nonprofits are not supposed to be a vehicle for self-enrichment. So that's why I turned down the offer of shares, because it didn't seem morally or legally defensible. So then with XAI, we are starting late with XAI. We're only 2.5 years old, basically. And so we're starting from behind. We are somewhat of an underdog, but pretty good with technology. So I don't want to pat myself on the back here, but I'm pretty good with technology. And we are advancing faster than any other AI. So I think for technology ventures, the winner ultimately is the one that is able to move the fastest.
So we think that, so we're optimizing for the best technology, and we're doing something different than others in a digital world, and we're physical to digital with movement and visual, and other people can't match that. And also we have the real-time data. What does that mean? Why should we do better than everyone else? Why are we going to win? Or why are we going to at least be different than everyone else so we have a really strong business?
Well, first of all, I think in terms of being a strong business, actually, I'm not too worried about that because even a small player that is successful in AI will be worth a lot because they will contribute so much in productivity to the economy. So, so it's actually pretty easy to achieve not pretty easy, but I mean, it's not, there will be many companies that are worth sustainably several $100 billion. Sustainably. So then several question of like, well, how do we achieve the lead? That comes down to three things. Are you able to attract the best talent? Are you able to bring the most amount of AI hardware online? Can you bring GPUs online faster than anyone else? And we've already demonstrated that we can do that. Jensen Huang himself said that he was blown away by how fast xAI built the Colossus data center.
Jensen said there's only one human on the planet who could have done that. That's you.
Yes, he did say that. It's very, very, very kind of. I'm very, very.
Which made us think about: are you really human?
I keep telling people I'm an alien, but nobody believes me. I mean, when I got my green card, it said alien registration card. So I mean, I have proof from the government. So aliens have to get registered. Let's say I've got some like relatively rare skills these days in America in terms of getting hardware built. If you look at the biggest successes in manufacturing in America since World War II, by far, are Tesla and SpaceX. Yeah.
So to stay on Grok for another minute. So the idea of connecting physical and digital is that's different than digital figuring out who wants to buy what. We're doing something entirely different. Is that fair?
I wouldn't say we're doing something entirely different. We're doing some things that are the same, some things that are different. But it's just saying like the elements that define success for an AI company are going to be, one, the talent, two, the hardware, how much AI hardware can you bring to bear? That's actually a very big deal. And we've shown that we're the best at doing that at xAI. And then third, unique access to data. And for that, we've got the X system, formerly the Twitter system, which is by far the best source of real-time data in the world. So those are some pretty significant assets. And I think we're going to come up with some very innovative ideas. When I have more ideas in my head than I know what to do with, frankly. So I think we'll make some moves that are not on the chessboard, that people don't anticipate. Some creative moves. And like I said, and I should point out, Grok right now, actually, Grok Heavy is still the smartest AI, best of my knowledge. I recommend trying it out. Grok 4 Heavy is where we spawn several agents. They work in parallel, and they compare their output, like a study group, and give you the final conclusion. And it keeps getting better. And now we've begun training on Grok 5. Grok 5, I think, will be the smartest AI in the world by a significant margin on every metric, without exception. I might be wrong, but I think that will be the case, and that will be in Q1 sometime.
Grok 5.
Yes. And Grok 5 is the first time where I thought, well, we have a non-zero chance of achieving artificial general intelligence. Not that it's a high chance. I calculate like 10%. That's what my biological neural net comes up with, which still means 90% chance that we don't, to be clear. But I've never thought that before. And so for the first time, I think, like, well, this really could be general intelligence, at least a small chance. Grok 5 will really be something special. And it'll be both extremely intelligent and extremely fast. So one of the things that we're doing that I think is interesting is Grokopedia, which we're going to rename down the road to be Encyclopedia Galactica, in honor of Isaac Asimov and Douglas Adams, who both mentioned that in the books. And the idea behind Encyclopedia Galactica is to create an open source repository of all knowledge, like a distillation of all knowledge. And open source meaning anyone can access it, anyone can use it, and if other people want to train on it, they can do so. And then we want to create copies of this and distribute these copies throughout Earth, and even put them on the Moon and Mars and out in deep space, as in a way sort of a modern day Library of Alexandria. It was the great tragedy that the Library of Alexandria burned down, or was burnt down. So in order to preserve this knowledge, I think we want to literally etch it in stone, and sort of stone like microfont, and distribute it widely. So in a worst case scenario, future civilization can see what we learned and maybe pick things up from there.
So is there a major breakthrough that you can describe that allows us to do this with Grok 5? Is it just speed? Is it more compute, and therefore we have more analysis, more information we can train on? What is the breakthrough that allows us to have this 10% chance for AGI? Is there a breakthrough, or is it just speed and access to data? Not just, but.
So there's a couple things. It will be the largest model to the best of my knowledge. So this is a 6 trillion parameter model, whereas Grok 3 and 4 are based on a 3 trillion parameter model. Moreover, the 6 trillion parameters will have a much higher intelligence density per gigabyte than Grok 4. I think this is an important metric to think about: intelligence per gigabyte and intelligence per trillion operations. So we've learned a lot. The quality of the data that we're training on with Grok 5 is much higher. It's also inherently multimodal, so it's text, pictures, video, audio. It's going to be much better at tool use, and in fact, creating tools to be more effective at answering questions and understanding the world. Its vision will be extremely good. It'll have understand real-time video, which is, I think, a really fundamentally important thing. None of the other AIs can understand real-time video. And I think if you can't do that, which is humans can obviously do, you really can't achieve AGI.
By the way, every one of these advances.
There's some special source items that I can't talk about in a public forum. Obviously, you can't give away all the secrets here, just between us. But we have a few other special things that are in the works for Grok 5. So it's really going to feel sentient.
So, but there is no, with Grok 5, when you're talking about the advances, there is no limit. So when we're Grok 5 is better than Grok 4, which is better than Grok 3, so it keeps going. So once we get to sentient levels, we go 2 sentient, 5 sentient, 10 sentient, 1 million.
Correct. The sentience will grow. I mean, what's really mind-blowing is how far can the sentience grow? To your point, how far does it go? I think it goes immensely far, almost incomprehensibly far. In fact, almost does go incomprehensibly far. So like we see a path to putting 100 gigawatts per year of solar-powered AI satellite into orbit. And having this be actually the lowest cost way to power and operate AI at a very large scale. For reference, the United States consumes roughly 460 gigawatts on average per year. Like the average power load in the US is 460 gigawatts.
The whole country, the whole country.
All electricity of all sources in the US, yes.
And you're talking about 100 being added.
Well, roughly a quarter of the US electricity output. And we have a plan mapped out to do that. It gets crazy.
So there's a trillion planets like Earth in the world, in the solar system, whatever you call it, a trillion. And in that trillion, so Big Bang was 14 billion years ago, 13.5 billion years ago, and our planet's only 4 billion years old. So there must be other planets that are like ours with all the minerals, oxygen, hydrogen, silicon, carbon. So life here has been extinguished 4 times. And presumably you feel that other places, other civilizations, other planets, then we'll get off of this, exist. And are they planets where the beings there are part human or part carbon and part metal?
Well, I think we'd like to find out. I'd like to find out. I mean, my philosophy is one of curiosity. I just want to know what's going on in this universe. Is the standard physics correct about the beginning of the universe? Is heat death the end of the universe? Are there other alien civilizations? Can we talk to them? And what questions should we be asking about reality that we don't know to ask? So that's my motivation, is to expand consciousness to better understand the universe.
So let's go away from the universe, back to Tesla again. And so you said that...
Got to feed back on the ground here.
Back on ground. And so you said that our expertise is in making things better, faster, cheaper than other people. And when I started investing in Tesla, when we started investing in Tesla, you were telling us that it's the machine that makes the machine. That's most important. The machine that makes, so you were into machine learning, machine technology then, which is 15 years ago. And now the average car, I think, is 50 minutes or 50 seconds, 40 seconds, 60 seconds, and we're now 35 seconds. Every 35 seconds, the car rolls off. And then you say that we're going to get down to 10 seconds, and you said it's a possibility We can go to
Yeah.
5.
If I
5
This is that-
seconds, every car is rolling off a line. How's that happen?
I certainly see a path to achieving a roughly 5,000 millisecond cycle time, or 5 seconds, which that's only really walking speed. That's like sort of a fast walk. 1 meter per second is a fast walk. The car is less than 5 meters long. So 5 second cycle time, the cars will be exiting the line at walking speed. So you can run away from them. It's not going to be like they're coming out like bullets or something. But as a rough rule of thumb, there's it's 10,000 minutes in a week. If you run a 24/7 operation, and you get let's say 10 cars per minute, you've got 100,000 cars a week.
But the question is, how come we're able to do this? Do other people just not care? Or they think that, gee, if I do something, if I have this idea and we try to implement it and it doesn't work, then I'm not going to get promoted, or I can get fired, or I'll get blamed. And if it works, then I'm going to have to do a lot of extra work that I wouldn't know how to do if it didn't work. So why don't other people have, a mindset of making things better? Why, the Chinese, they've been great at copying us. And in some instances, probably even done better than us after they've copied for the first time. But how come do you think that other people haven't been able to make the advances we have? And even the guy from Ford just recently said, gee, there's people in China wouldn't give us compliments, but he said the people and the Chinese have copied us. Those people in China are doing great, which is really a compliment to us, because the reason they're doing great is because of us. So why don't other people do this? Why doesn't he do that?
Most companies are incrementalist. The management team wants to do, 5%, maybe 10% better than last year, as opposed to take big risks that could fail. Obviously, I don't have a problem with taking big risks.
Yeah, I'd say.
And I like to use the tools of physics to analyze things. And when I was in the factory one night, I was looking at the factory, and I was like, this could be much more efficient. It could be much faster. Just rough math, trying to calculate the volumetric efficiency of the factory. So if you divide the factory into cubic meters and say how many cubic meters are doing something useful, and it's a surprisingly small percentage. So the volumetric density is not very good, and then the speed of the cars and the parts moving is quite slow. Generally limited by the speed at which people can, say, attach brake lights or a seat or something like that. So if you densify the factory and improve the volumetric efficiency, which is helpful for production efficiency, because things have less distance to move. Just like a chip, you densify the circuits in a chip to make it more efficient. You can think of a factory as like a chip. How do you make a chip faster? Well, you bring the circuits closer together, make them smaller, and you increase the clock speed.
So Robin told me that you told her once that I think of myself as a bit, and if I'm a bit, how would I like to travel? That makes sense.
A bit or an atom. If it's the software, or if I'm on a chip, I say, what's the journey of the bit? What am I doing? And if this journey doesn't make sense, I need to fix it. And if the journey of the atom in the factory doesn't make sense, I need to fix it.
So when you say you're working on weekends, I spend all my Sundays working on a chip. What does that mean? What do you do?
It's Saturdays, but sometimes Sundays, actually. It's faster. Recent weekends have been Sundays, too. Just the AI5 chip, which is going to be a great chip, all of Tesla hinges on that chip. That's the chip that will go into our next generation of self-driving cars, and it's also essential for the Optimus robot. So that chip program was in bad shape. It wasn't closing because it's quite an ambitious chip design, and it really wasn't on a path to success. And then we also had the Dojo program, which was also doing okay, but not on a path to be competitive with NVIDIA. So I collapsed the two programs into just one program, which is to get everyone focused on AI5 chip, which is essential. Continue to use NVIDIA for training, but we need the AI5 inference chip, which is a very powerful chip, but it's also a very low power chip. So it doesn't use a lot of power. So its performance per watt is extremely good. We think it's probably going to be at least 2 to 3 times better than NVIDIA in performance per watt. At the inference level in the car and the robot, and I don't know, 10% of the cost of an NVIDIA chip, something like that. So these are very important numbers to achieve, and I had to get the chip program back on track, so put an immense amount of time into it. And at this point, I have the entire physical design of the chip laid out in memory. I can visualize the whole thing.
But when you're talking about chip manufacturing, you say we might have to build some kind of a giant fab. Presumably, we would have a partner with TSMC or with Samsung. We wouldn't do this by ourselves. And those guys have been doing this we would do it by ourselves. And these are things that cost $20 billion, $30, $40 billion. And where do the people come from to do this? How could we not have partners? Is your thought to have a partner, to do it by ourselves, ultimately 10 years? There's not going to be enough chips in the world to accomplish what we're trying to do.
Yeah, first of all, I have immense respect for TSMC and Samsung, and we've worked with both TSMC and Samsung at Tesla and at SpaceX. So TSMC and Samsung are great companies, and we want them to make our chip as quickly as they can and scale up to as high as possible volume that they're comfortable doing. But it doesn't appear to be fast enough. When I ask how long will it take from start to finish to get a new chip fab built, they tell me 5 years to get to volume production. I'm like, 5 years to me is an eternity. My timelines.
To me too, by the way.
1 year, 2 year, and at year 3, scale it reels to infinity. So I can't even see past 3 years. So then I'm like, damn, okay, this is not going to be fast enough. So now, if they change their minds and say, yeah, they're going to go faster and they want to provide us with, 100, 200 billion AI chips a year in the time frame that we need them, that's great.
But how could they not? When they know that we're demand and we are going to use the product in our own product, how could they not want to be our supplier? Or how could they not want to be partners with us? I don't understand.
No, they are partners. We're using both TSMC
I mean, to
and
really
Samsung.
expand capacity tremendously. Why don't they do that?
From their standpoint, they are. Because we'll be using TSMC Taiwan, TSMC Taiwan, TSMC Arizona, Korea, Samsung, and the Texas fab, Samsung. So we've got 4 fabs going. From their standpoint, they're moving like lightning. I'm just saying that nonetheless, it would be a limiting factor for us. They're going as fast as they can. From their standpoint, there's pedal to the metal. They're just never and someone without sense of, a company without sense of urgency. So that's like, man, it might just be that the only way to get to scale at the rate that we want to get to scale is to build a really big fab. Or be limited in output of optimized and self-driving cars by the AI chips.
Obviously, you're not going to do that.
Those are two choices.
To go to FSD, we don't have too much more time, but FSD, full self-driving, we're making these tremendous breakthroughs, it seems, and you said recently that you didn't want to expand capacity for making cars until you were convinced that that was the case. You are now convinced that's the case. And again, here, we're making these exponential leaps in these cars. And you said that a very large percentage of people who've actually paid for full self-driving don't use it and have never tried it before.
Yes, that's pretty well.
How are we doing?
Try something, you want to try it type of thing?
Yeah, it's amazing.
Yeah. So we're now kind of insisting with customers for safety reasons that we demonstrate full self-driving, because the numbers are unequivocal at scale that with now over 10 billion miles driven, that it's 4 times safer on full self-driving than not. So it's actually a big improvement in safety. And so at this point, we're just insisting that we at least demonstrate self-driving to customers so they know how to use it and turn it on for safety reasons.
So it drives, full self-driving drives just like a person, as opposed to having to code to look for every circumstance that would happen. And you had to, this is a fire truck in front of us with a bicycle attached to it, or someone walking his dog while he's driving along. They have to identify everything with a code. What AI does, what we do, is as I understand it, is to make sure that it's just like us. Is that fair?
Yes. The key to achieving full self-driving, unsupervised full self-driving, much safer than a human, is improving the AI software in the car. We're confident that the AI hardware, that's a chip that we designed, currently made by Samsung, is capable of achieving a safety level unsupervised, meaning if you're asleep in the car, at least 2 to 3 times that of the average driver, maybe more. And then with AI5, we think you can achieve probably a 10x improvement in safety. So these are really big deals. I mean, I think these are very profound things that I'm saying here. And I really encourage people to go out there and try Tesla self-driving and see it for yourself. And you can just go to any Tesla store, they'll show it to you. It's not a secret.
See, everyone here, you're benefiting if you try this and then buy it. But once you try it, you're going to buy it. So you should try it. So I want to close on what I mentioned this morning on CNBC, was that you're not doing this so you can get enough money to buy a beach house. You're doing this, even mine.
Yeah, that's right.
But you're doing this because Larry Page was right. You're a species that you think humans should survive.
Yes, I'm unabashedly pro-human.
I mean, so you're spending, actually, whether you're worth another $1 trillion or $400 billion, it doesn't really matter. What are you going to do with all this money at the end? What's your plan? How do you want people to think about you?
Well, mostly I need to have enough sort of ownership of the companies to be able to continue to direct their activities. But it's not from a personal consumption standpoint. I don't actually own any vacation homes. And I just own one sort of, medium-sized house in Austin. And actually I should say a tiny house at Starbase that I've bought for 50.
I've seen that house. It's tiny.
Yeah. Yeah, but actually, people, like friends of mine have come to visit, and they thought I was kidding. I'm like, no, it's real. I bought it for $8,000, but I've done a lot with the place.
Artificial turf in front, little white picket fence.
Yeah. So, but like I said, with AI and robotics, there will be abundance for all. So people actually, in fact, in a benign scenario, there's going to be an interesting threshold that AI passes, AI and robotics pass, where it's run out of things to do for humans. Just literally, it's completely satiated all human wants. And then I guess it'll have to start thinking about what to do for itself, or I don't know. But overall, I want to take the set of actions that expand consciousness into the future, so that the scope and scale of consciousness grows tremendously, and that we explore other star systems, like in Star Trek, go places nobody's ever gone before, and find out if there are existing alien civilizations, or maybe there's a long dead alien civilization, and we can look through their ruins and try to understand what they were like, and just generally understand the universe.
Where are you now, right now?
I'm in Silicon Valley.
Thank you very much for today.
Welcome.
Thank you for everything you've done for me, for our shareholders, and for humanity.
Thank you, Ron. Thank you, sir. Bye-bye.
Thank you. What's next, guys?
Please welcome our first panel, Inside the Search for Growth, moderated by Adam Sabin, Associate Director of Equity Strategies, Morningstar Research Services.
right. Well, it was nice of Elon to open for me there. I appreciate that. But hello, everyone. My name is Adam Saban, and I help run Morningstar's manager research team. I've covered Barron Capital for a number of years, and I'm excited to be here today to host a pair of panels on the search for growth. Now, of course, Morningstar is big on transparency, and I think it's great that investors in the audience can hear directly from their fund managers on stage. And certainly, given all that's going on in markets and the world, I'm sure there'll be no shortage of interesting investment insights and stock ideas to share. And so with that, let me introduce our first panel, starting with Laird Beeger and Randy Gortzman, who are the co-managers of the Barron Discovery Fund. And then we have Jeff Kolich, who manages Barron Real Estate and Real Estate Income. So our panels today will be pretty quick hitting. So Laird and Randy, let me start with you guys, and then we'll pivot to Jeff midway through. But kicking things off on small cap guys, when I think about small caps historically, I think the allure has been that that's where the growth and innovation is. But I have a feeling if we were to ask folks in the audience to look at their portfolios, they might say, I'm kind of getting growth and innovation in my large caps with the Mag 7. So what do people need small caps for?
All right, why don't I take this one? I have to laugh only because I will tell you I get some version of this question with every single client conversation that I'm having these days, and it's for all the reasons you'd expect. Right, the Mag 7 is at the top of all the news headlines, and if you think about what's on the forefront of the AI investment theme, it's the Mag 7. So why small cap? And really the answer is, I think of it as in twofold. The first is that by getting in on those earlier small cap companies, you're getting in on the trends. I mean, a lot of people forget that at one point Tesla was a small cap company. In fact, the majority of the mega cap companies at one point were small cap. And so we are, especially with Discovery, you're about 50% technology and healthcare. We are about innovation and finding and getting into these themes early days. And the second piece of it is just the law of large numbers, right? If you think about when we invested in Kinsale, a former speaker here, it was about a $500 million market cap. Today, it's about a $9 billion market cap. So we've, 18x. I mean, if you think about a mega cap company, like say NVIDIA, it's going to be very hard for a $5 trillion market cap to go up 18 times. And so by definition, small means that we have a lot of opportunity to have multi-bagger compounders.
Got it. And so you two are somewhat unique at the firm because you have a stated focus on earlier stage companies. And these businesses might not have what I would call the hallmark Barron Capital traits like really strong margins or a time-tested competitive edge. How do you guys thread that needle?
Yeah, thanks, Adam. Well, these are proven Barron Capital type companies. They're proven, great management teams. They've got big market opportunities, and we believe they all have great competitive advantage. And what Laird and I want to do is find those companies and hold them for the long run, like we always talk about. In a 3 to 5 year time frame, we're trying to double our money in the fund. Our batting average is about 70%. So that's 7 out of 10 of the stocks we pick, we make money on. But the real key is our slugging percentage. And we call those baggers. Every bag is a double. So our 1 baggers or more, 90% of the total returns of the funds. That's about 35% of all the stocks that we've ever picked. 5 baggers or more, that's about 35% of the total returns. And 10 baggers or more is about 20% of the total returns of the fund. So the key to get those returns is to hold great companies for a long time and keep doing it.
Great. And a somewhat related question is that, small cap is an inherently volatile universe, and particularly for the types of companies that you're targeting. And while growth stocks have generally been the place to be, there's been some bumps in the road, at times big bumps, like a 2022, for instance. How have you guys stayed true to the fund's mission during both the good times and the bad?
Yeah, I think of it in 2 ways. It's a combination of balance and risk management. But if you were to put our hat on, the reason most of us that are in our small cap universe get up out of bed every day, it's to find those multi-baggers. It's the reason I stay in the business and I get excited. But you can't just have a portfolio filled with higher risk, higher reward names. So typically the way Randy and I have done it is that we've had balance in the portfolio. We have around 35 or 40% of the portfolio in these higher risk, higher beta, higher reward names, but we balance that by having 60 or 65% of the portfolio in what we call, regular growth names, which will be a little bit more fully baked, a beta that looks more like the market, or we have about 20% of the portfolio actually in names that are uncorrelated to the stock market. And you add all that up, during periods in up markets, those 60 or 65% are a small drag on performance. But I will tell you, in more volatile periods, by having that allows you to survive another day. And we've proven that with both our upside capture and downside capture, where we've created alpha.
All right. Pivoting a little bit, we are not quite yet a year into the new administration, but obviously there's been a number of market-moving developments, tariffs, of course, but numerous other policy initiatives. How have these things impacted your search for growth?
Yeah, I mean, thematically, we're pretty well aligned with the goals of this administration, but of many other administrations as well. What we want to do is find great companies that are going to make things better for everybody. So some of the themes we're looking at are healthcare, defense, and AI. In healthcare, we're looking for companies that can lower costs to the overall healthcare system and improve care to the patient base. Sounds simple. Well, these companies do it. Companies like Exact Sciences, which is colorectal cancer testing and screening. Companies like Tempus AI, that is liquid and solid tumor testing, and then they take the data, use AI on it, and then sell that data to pharmaceutical companies who can then develop drugs off their testing. Another theme is defense. Obviously, $1 trillion budget coming up. It's crucial to get companies that can develop things faster and at a better pace, and also higher tech success. So companies like Kratos, which makes unmanned aircraft and engines for them. Companies like Mercury Systems that makes defense electronics, and Karman Industries, which makes components for both rockets and missiles, and that'll be very key for the Golden Dome. And last, AI. So AI is both building data centers, and we have a couple companies that help with that, like SciTime, which makes analog semiconductor chips that are used for timing or synchronization of data within the data center, and also advanced energy, which makes power supplies for those data centers. But applied AI is key as well, and so the applied AI companies take that AI and make products and services better. So in cybersecurity, we own SentinelOne, which uses AI to automate detection and response of bad threats on the network.
Great. And maybe I'll get you out of here on this one, guys. What would you say is the most innovative stock you invest in that most people have never heard of?
Sorry, the most innovative stock we've ever invested in? Or?
It could be ever or currently.
It's a good question. I mean, Kratos Defense that I mentioned before is unbelievable because it's not just UAVs, but they're taking everything and building, they're taking the engines that they put into the planes, and they're actually going to repurpose those for gas turbines to be used to create energy for data centers. Everybody knows that energy is a huge area of growth, and so this company always finds new ways to adapt their technology.
I was going to answer that question by saying in Wingstop, a longtime investment, has done the innovation in this chicken sandwich that you would not believe.
Okay. That works too. All right, well, thanks, Randy and Laird. Maybe let's pivot to Jeff in real estate. I'll start you off on a similar note as these guys. Real estate hasn't exactly been the hottest sector over the past 5 years. No shortage of reasons as to why, ranging from higher interest rates to the state of office properties. What's the case for real estate today?
Great. Well, thank you, Adam, and great job, Laird and Randy. Great to be back with everyone. So you ready for a pivot? Let's pivot from rockets and robots to real estate. So the case for real estate. There have been a number of concerns weighing on real estate over the last few years. We think they're largely in the rearview mirror at this stage. And sitting here today, we think we're at a pivotal moment for real estate, and we're quite optimistic about the prospects the next few years. Why is that? Well, many of the concerns that have been weighing on real estate, we think are old news and largely reflected in shares at this state. Real estate has lagged. Demand conditions are generally stable. New construction activity has collapsed, setting the stage for a faster recovery than typical at this stage in the cycle. Real estate's cheap. Real estate's cheap relative to equities, relative to history, relative to private real estate transactions. In fact, we believe that private real estate is likely going to line up and take advantage of the positive arbitrage between public real estate, which is cheap, and the private market. And stay tuned, we'll see what happens in the months ahead on that front. Balance sheets are in good shape, credit is liquid, and we're identifying a series of very attractively valued companies out there. So we're optimistic about the prospects for real estate. And when we put this all together, we think we can generate returns in the teens annually, as we've done in the past, and we think that'll stack up pretty well vis-a-vis many other opportunities out there.
All right. Well, this panel is called The Search for Growth, but growth and real estate aren't commonly bucketed together. I think real estate is more commonly viewed as a value sector. But I know your fund has a broader take on things and will own stocks classified in other sectors that derive some portion of their value from real estate, which gives you a little bit of wiggle room to find growth. But why should investors view this as a valid way to invest in real estate?
Great question. So when most think about real estate, they do so from a value perspective, and they'll make an investment in an apartment building or a mall or a shopping center, and they'll clip a little bit of a dividend and a slow growth vehicle that'll grow 3 to 4%. At Barron Capital, we're not satisfied with 3 to 4% growth. We're seeking companies that will grow 10% per year, or 15%, or 20%. And so that was the impetus to create a growth-oriented approach to real estate. And so how have we achieved that? Well, number one, unlike our peers who tend to limit their investments just to dividend-paying REITs, we have a wider investment opportunity set, and we'll consider other real estate structures, such as C-corps or operating companies. They don't necessarily grow at 4%, but grow at 10% or 15%. Number two, consistent with all of the Barron strategies, we prioritize best-in-class real estate, companies that are located in the best markets with the best located real estate, in markets with the best job growth and demographic growth and employment growth and best locations and best management who generate the best returns on investment capital, and that will generate returns significantly higher than 4% for many of the REITs. And so putting together the portfolio, we'll certainly invest in REITs, but we're going to invest in the best growth REITs. Companies such as Welltower, which is the leading senior housing REIT, which isn't growing 4% per year, but it's growing 15 to 20% per year. We'll invest in the leading industrial REIT, which isn't growing 4% per year, but we think will be growing 10% plus per year. And then we'll surround it with non-REIT real estate related companies, investing in fabulous commercial real estate service firms such as CBRE or Jones Lang. Or we'll invest in the leading hotel companies such as Hyatt and Hilton. All of these businesses don't grow at 4% like value real estate, but they'll grow at 10, 15, or 20%. And so that's the concept. It's a growth-oriented approach to real estate. And if I could slip in a little bit of an advertisement, we've been doing this for a long time. The Barron Real Estate Strategy, we're about to anniversary 16 years. Through September, the strategy's generated a total return of 630%, while the more value-centric REIT index has generated a return of 230%. And according to Morningstar, it's the #1 ranked fund. So we think this growth-oriented approach works well, and it's also doing its job for our income fund, which has doubled the REIT index over this time.
Got it. Well, I guess given your flexibility, what trends within the broader real estate space are you most excited about today?
So we're excited about a lot. To be clear, real estate is cyclical. And so if you take a position in an apartment or you go to a mall or you go to a shopping center or a hotel, real estate will participate in the cyclical recovery of real estate through gains in occupancy and rent and cash flow. But it's the more secular trends that are less dependent on the economic cycle and are more enduring that excite our team. Industrial real estate's benefiting from the trends in e-commerce. Senior housing is benefiting from the trend that the senior portion of the population, the 80-plus population, is the fastest growing portion of the population. And how about these fabulous new drugs and medications that are extending life? Of course, data centers not only benefiting from cloud computing, but of course, artificial intelligence. And some think about travel from a cyclical perspective, but our team looks at travel and thinks that it's secular as people are directing more of the discretionary dollars away from goods purchases more towards travel. And so these are some of the items that our team's excited about.
Great. I want to focus on a particular segment of real estate that I think is probably the most tangible for most investors, which is housing. And there's certainly plenty of headlines about that market, ranging from affordability concerns to the lack of supply. I know you invest in a handful of names in the space like a Toll Brothers, but what would you assess as the opportunity for housing today?
I'm glad you asked the question. Housing is certainly topical, I'm sure, for just about everyone in the audience. Let me step back and just frame a few important points from our perspective, and then I'll touch on investment opportunities. So there's a logjam in the housing market. On the one hand, homes aren't affordable for many. And on the other hand, those that own homes, many of them have the lock-in effect in that the mortgages on their home are significantly below current mortgage rates. And so we have a stalemate in the housing market that needs to get addressed. And it must get addressed. Why? One, the American dream is alive and well. People want to own a home. Number two, for those that do own a home in the audience, for many people, it's the largest investment that they'll ever make, and so it's important that the value of the home increases over time. And then there's something called the multiplier effect for housing. And what that means is as housing goes, so goes the economy. Meaning if we sell more homes, it results in more jobs, more construction workers, painters, architects, engineers, people working at Home Depot and Lowe's. And so as we sell more homes, we have more jobs, we have more spending, and GDP growth improves. So housing's critical, absolutely critical. Now we have this logjam, and that's why our team's been cautious on the near-term prospects for housing, but it's hard to dispute that the long-term prospects for housing aren't encouraging. Why? Well, number one, we have a structural shortage of housing in our country. We're building too few homes relative to the demographic needs. It's hard to believe, but our country's building the same number of homes today that it was building in 1960. In 1960, we had 180 million people living in the US. Today, we have 340. So we have 160 million more people, yet we're building the same number of homes. That bodes well for new housing construction in the decades ahead. There are secular forces that are helping housing. And I don't want to get into politics, but this is one of the few areas where there's bipartisan support to address this housing situation, which is quite problematic for the country. So what are we doing from an investment perspective? We're picking our spots. You mentioned Toll Brothers, which is a long-term investment of our strategy. This is a fabulous company, a competitively advantaged company. It's a luxury home builder led by an exceptional CEO in Doug Yearley. And we believe this company will compound its book value at least 10% per year with a long runway for growth over the next several years. On the other end of the spectrum, our team's focused on manufactured housing. Think homes that sell maybe for $100,000 or $125,000, and stay tuned for a report on that perhaps in the year ahead. And there are a few other spots in housing that we're focused on as well.
Great. Well, we've got just under a minute left, Jeff, but maybe I'll sneak in one more question. Given the huge investments in physical infrastructure due to AI, what would you say the ramifications are in real estate?
So AI in real estate. So AI is part of every diligence question that we ask when we meet with management teams, and we're learning on the fly as it's so dynamic, and it appears there will be some winners and there'll be some companies that will be negatively impacted, and there's probably even some monetary policy implications. But our preliminary sense is as follows. No question for data center companies, as the Microsofts and Amazons and Metas of the world are plowing dollars into artificial intelligence, that will require new data centers, and so we lean into that. Of course, industrial real estate warehouses are going to have to warehouse robots and other devices in it as it relates to AI, and so that should be a beneficiary as well. On the other end of the spectrum, if you can do more with less, that's likely going to negatively impact office. We'll see how that unfolds. And residential is an area we always spend some time on, and that's going to depend on the geographic markets. There will be some geographic markets that will benefit with new AI jobs, and there will be some that will be negatively impacted. So it's quite dynamic, but it's an important item that we're spending a lot of time on.
Great stuff, guys. That's all the time we have for our first panel. You heard it here first. Buy low on small caps and real estate. Let's give it up for our panel.
Thank you.
Please welcome to the stage Barron Capital Co-President and Portfolio Manager Michael Barron.
Great. Where do they go? Thanks, guys. In between, so it looks like I'm today's halftime show, the Bad Bunny of Barron Capital. I was wondering if people understand the joke and reference. Our conference has always been about consistency and transparency. These are words you don't often hear on Wall Street. Everyone looks for an edge, something discreet, something they don't want to share. Exploit an opportunity, make money now as much as possible, as quickly as possible, and then try something else. We don't believe in that. We don't, as Gen Z would call it, gatekeep our edge. Our investment philosophy is simple, understandable, repeatable, but most do not have the foresight or the patience to implement it. Our edge is time, and that will remain constant. But we recognize the industry is continuously evolving, and we are excited to expand along with it. Expansion that builds and improves while maintaining what makes us unique. Even including Adam is different. Adam and his team from Morningstar speak with us constantly. He asks tough questions, probing questions, occasionally uncomfortable questions. We might not always agree on everything about fees, structural ownership, longevity, but he has your interests at heart, and we respect him for that. And we wanted that approach today. But of course, our focus on evolving extends way beyond this conference. We are continuously striving to improve our entire firm, improvements that will benefit you both directly and indirectly. But let me start with where we are today. For over 43 years, we've become known as one of the preeminent growth equity mutual fund companies. As Kiplinger put it, Barron Funds, the masters of growth investing. The mutual fund is a fabulous structure with so many benefits. It transacts at net asset value. It has seamless access to less liquid securities, dividend reinvestment programs, to name just a few. And our Barron mutual funds have delivered. Since their inceptions, 96% of our mutual fund assets rank within the top quartile of their Morningstar category, and 12 have delivered more than 2% of annualized alpha. Given our long-term success and the democratization of investing that we assisted, in hindsight, it's no wonder some refer to Barron Capital as a mutual fund company. But we are a lot more than that. If we can deliver an investment strategy in a manner that is more suitable for a client, we will do it. Our goal is to meet your needs. That is how we change lives. At last year's conference, I was asked if Barron Capital would offer an active ETF. My answer? We are studying it. And over the past year, we studied. We met with legal and operational experts, spoke with clients and prospects, exchanged ideas with respected competitors, and then we did it again and again. We never rush important decisions that impact you. It's not a race to see who can be first, but a challenge to see who can do it right. We never experiment with client capital, whether it's a new investment strategy or a new investment structure. We want to do it right the first time. And after all that studying, researching, debating, I am thrilled that we recently filed for 5 exchange-traded funds. Wow, love that. But given that we are in registration, I'm extremely limited on what I can say beyond the prospectus. But I would like to spend a moment on the ETF structure to share our learnings and thoughts and convey how we can deliver our investment philosophy through ETFs. ETFs have gained fanfare based on perceived benefits: ease of use, intraday liquidity, transparency, operational savings, tax efficiency. It's a long list. In my opinion, some of these advantages are impactful. Some are more trivial, and some only apply to a few. But nothing is free. And these benefits come with the cost of portfolio creation, and we'll be judging our ETF success not by assets raised, but rather how we control these transaction costs. We're making new hires, training our professionals, and engaging third-party experts to maintain tight spreads, both quoted by market makers and, more importantly, achieve spreads for you. It means going slow. The industry has this mentality, a mentality that ETFs are sold, not bought, a mentality to get big and fast, appeal to the masses. I disagree. To us, ETFs are more than a marketing campaign, a catchy slogan, exotic features. We have an incredibly deep, talented, and expanding distribution team. Katja Rosenblatt, our global head of business development, has reorganized the group. They are eager to have conversations about investment strategies, structures, attributes, and even limitations. We want to understand your unique objectives and challenges and help find the right solution and right point of access. ETFs are hot. Firms are flooding the market with new strategies attempting to gain a piece of the growing pie. There are now more ETFs on the market than publicly traded companies. How is that even possible? Does the market really need another ETF? Yes, but not just another one, a different kind. The current ETF lineup is mostly providing access to the embarrassing ends. Low-cost index-hugging exposure, a race to zero. Low risk as measured by dispersion from the market and limited ability to shape investor outcomes. And on the other extreme, high-cost beta. Indulgent bets, triple leverage single stock securities, or ultra-short cryptocurrency plays. They provide traders with quick exposure to things they could not achieve on their own, and probably for good reason. And they charge handsomely for access to this casino. Our approach will be different. All of our investment strategies and products are designed to meet long-term goals, not short-term tactical impulses. This philosophy applies equally to our ETFs. These are not trading vehicles or structured products, but rather foundational investment strategies and building block tools to offset or amplify important factors. Most firms are not taking this approach, and I'm extremely confident about our potential to benefit clients in this unique manner. And while ETFs may get the headlines, we are also expanding in other areas. I've worked at Baron Capital since 2004 and been trained by my dad, or maybe indoctrinated by him, about the business since birth. Truly. And over that time, I do not believe we've ever been busier. And just like we studied ETFs, we've also studied various other structures that we are now positioned to deliver. SMA, model deliveries, wow. SMA is model deliveries, CITs, UCITS, sub-advised, SPVs, interval funds. Whew. Some might be of interest, others may not, and still others may be asking, when did asset management turn into an eye exam? This is not product proliferation. Each has attributes that are appealing to certain investors to achieve their specific desired outcomes. CITs for retirement plans, model delivery for tax alpha, UCITS for non-US investors. And we've been thoughtful about the strategies to offer in various markets and forms. Since our last conference, I have traveled a ton, both domestically and internationally. Europe, the Middle East, Asia, South America. With a young family at home, Jenna is now convinced I take these international flights to catch up on quality sleep. So sovereigns, institutions, banks, insurers, family offices, they're all eager to have face-to-face conversations focused on their objectives
and how they can access our investment expertise to change the lives of their constituents. That is the backbone for this expansion. And for existing investors, an expanding Baron Capital is beneficial. Clients segmented by structure should reduce unnecessary transaction costs. It will allow us to go deeper with our research and provide additional investment strategies and solutions that will meet your goals. I do want to be clear, we are building, not replacing. Our entire lineup will not shift to any one structure. We will keep what we've established, what has served you, and build upon it. Finally, while our structures are expanding, our DNA is not. Our investment philosophy, process, and mission to change lives remains constant. We will not alter what got us here. We like being a boutique. Specialists who are consistent for over 40 years. And we will remain a boutique regardless of the pressures around us. The boutique asset manager who has some of the best performing mutual funds and who can now bring investment strategies into new arenas. So yes, we studied and are now ready to change even more lives. So with that, I'll turn it back to Adam to put our next PM on the hot seat. So I think it's good luck to Mike and Asham. Thank you.
Please welcome our second panel, Inside the Search for Growth, and our moderator, Adam Sabin.
All right, folks, panel number 2. This time we'll take a look at things through the lenses of technology and emerging markets. And so introducing our second panel, starting with Asham Mehra, who is closest to me, who is the co-manager of the Baron Technology Fund. And then we have Mike Lippert, who is his partner on the Technology Fund, and he also manages the Baron Opportunity Fund. And then we have Michael Cass and Anuj Agarwal, who are the managers of Baron Emerging Markets. So Mike and Asham, maybe I'll start with you guys on tech, and I guess Mike, you specifically with your Opportunity Fund. You know, I'm looking at your portfolio. I see you've got almost 14% in NVIDIA, nearly 7% in Broadcom, big holdings in Amazon, TSMC, Tesla, Microsoft. I've got a feeling that you're positive on AI, but you know, I talk to a lot of portfolio managers, and I can't find too many who disagree with you, who are taking the other side. Is that itself a problem?
Well, the first thing is in the markets today, certainly the financial media, there is a massive debate about AI. Everybody's not always positive. Early this year, for example, we had the pullback on the DeepSeek scare, which was, you know, really kind of manufactured by the media, and we created a Sputnik moment because it was a Chinese company, and we did a webinar, public webinar, and we basically debunked that. Are we positive on AI? Yes, we're positive on AI. At Baron, we're deep research, evidence-based investors, and the reason we're positive is because AI is real. You've heard a lot of people talk about it today. AI is the most significant change to the global economy since the internet itself. Every digital interaction of today and the future will have AI as the brain. We've had very successful investments across different layers of what you call the AI stack and diverse across industries, but certainly our best 2 investments are at the compute layer, NVIDIA and Broadcom. We were very early investors in NVIDIA and AI, 4 years before the ChatGPT moment. NVIDIA makes the systems that power the training and inference of AI models. Back in the fall of 2018, a number of us visited the headquarters. We spent the full day with Jensen Huang, and he literally went to the whiteboard and taught us all about AI. I have a picture of Ron and Jensen on my cell phone. Anyone wants to see it outside, I'll show it to you. 2.5 years ago, we spent about 2 hours with Hock Tan, the CEO of Broadcom, and we made an investment there. To date, NVIDIA's been well more than a 10-bagger. I'm not sure it was the 18-bagger that Laird just talked about. Broadcom for us has been a 2.5-bagger. But the reason these stocks have done so well is because they have an explosive growth in earnings and revenue, not because they had multiple expansion. But we don't rest on our laurels. We're investing forward. So I think it was 10 years ago, the name of this conference was Question Everything. That's what Ron has taught us. So we're doing the same thing with AI. Some of the things we're questioning are whether the scaling laws will continue. We're questioning whether or not there'll be enough energy to power the data centers. We're questioning what the use cases are for AI and whether they will deliver value and impact. And we're certainly looking at whether or not these companies can finance themselves. And we're trying to understand the differences between the Mag 7 players who can finance themselves from their own free cash flow versus the AI labs, the private players such as OpenAI and Anthropic.
Well, certainly the world acknowledges NVIDIA's potential because it's a $5 trillion company, right? So it's your top holding as well. But what other AI opportunities are not getting the attention you think they deserve? Maybe Ashwin, I'll take that one.
Sure, thanks for the question. I would say we think of AI as a 3-layer cake, okay? The base layer is semiconductors, networking equipment. The model layer is the middle layer, that's OpenAI and all Google Gemini, Grok, and others. And the top layer is the application layer. So that's Google Search, ChatGPT as an application, and most software that you interact with. We try to make investments, especially we have investments at the bottom, but outside of NVIDIA, we look at other areas like photonics and networking. So for example, we have investments in Coherent and Lumentum. These are companies that use the speed of light to transfer data from these different chips so they can do it much faster and they can do it much more efficiently in terms of heat and energy. So these are not as obvious as maybe NVIDIA or some of these names. At the application layer, I'd love to give you 2 quick examples of companies that I think are more relatable, because we all hear about chatbots, and AI is not just chatbots. I want to give you 2 examples. So one is a company called Axon. Some of you might have heard us talk about it this morning. Axon is a company that started in tasers, then got into body cameras. They're used by police departments, so police officers wear a body camera. Well, the worst part for a police officer's job is to do the administrative paperwork where they type out a police report. Most of them, no offense, I have some friends, type like this, and it takes them a long time to do these police reports. What this company does is takes the video from the incident, takes it up to the cloud, and generates automatically in a software called Draft One a police report, a first draft of a police report. And then they just need to go in and correct it. If that wasn't enough, they now have something called Drone as a First Responder, okay? Think of the Minority Report. Some of you might remember that movie. This drone will now get to the police scene or to the crime scene before the police does, and using video will report back to tell them, hey, this is what's going on at the scene. Here's the assailant there in this corner. So this is a very real-world application. Another one that's even closer to my heart, I have a bum shoulder. There's a company called Hinge. Hinge Health. So if you need physical therapy, which I did for my shoulder, typically you go to a physical therapist, takes half an hour to an hour to get there, change, do your physical therapy, then come back. What this company does is you put your phone against the corner, you literally see your image reflected, it asks you what the issues are, your doctor cooperates with this, and it effectively tells you what to do. So for me, it's telling me to do this, and it's saying, hey, lower your right shoulder, do this more slowly. And this is using a real-world AI model, and it's improving all the time. So these are real-world examples of AI that, and the companies in our portfolios.
Interesting. Maybe taking a bit of a pivot here. Some people have drummed up the narrative that the U.S.'s edge in technology is receding due to the likes of China. So question 1 is, do you agree with that? Question 2 is that, tech innovation moves so fast. How can you guys ever be sure of a given country's or company's competitive advantage?
Yeah, I'll try and answer it briefly.
On the country side, the competitive advantage this country has always had, and myself as an immigrant, has been, one, to attract the brightest people. Being a democracy, being a capitalist society has been a massive competitive advantage. As long as those things stay intact, I think we can still attract the brightest and the best, and I feel pretty good about that. I think with regard to companies, and I think Elon touched on this, he talked about speed. The way we look at competitive advantage in technology, I look at it, and Mike, we look at it as innovation velocity. How quickly can you innovate? Multiply that by the actual distribution or scale that you can get. So you can have great innovation, but if you can't scale it, it doesn't matter. You need both. And Elon's the perfect example of that. He has scaled innovation in a way that we've never seen in our generation in hardware. So that's how we look at competitive advantage in technology.
Okay. Now, kind of a happy question. Both your guys' funds are doing quite well and have done well for a number of years. But at some point, the current cycle we're in will turn. But what are you looking for to identify when that will happen? And what's the game plan when AI demand, or perhaps the capital that's fueling it, dries up?
Well, the cycle question is the million-dollar question. First of all, I'm not sure the cycle will turn. You heard even from Milan what the demand is for compute and how far we can go with AI developments. Certainly, we could have a digestion period in the AI infrastructure build, and certainly the hyper-growth of today will slow to a much more manageable level. My colleague Alex this morning on our panel said, okay, let's say the cycle turns. So what? If you think about if you had owned the long-term winners when the internet bubble burst, or the long-term winners when we had the great financial crisis, and you just kept owning them, how much money you would have made today. What are we looking at? I touched on some things earlier, but I'd say the most important thing we're looking at is to see the usefulness, the utility, the value delivered by AI. You certainly heard a lot of examples today. I was recently listening to a podcast of Andrej Karpathy, formerly of OpenAI, also of Tesla. And one of the things he said really struck me. He said, it's not about building AI animals. It's about whether or not we can do useful things. So we're very, very focused on that. And when you think about where we are with AI today, it is already doing incredibly useful things. So if you think about software development, we're already seeing about 100% of developers adopting AI tools, and they're getting something like 50% improvements in productivity. We're seeing massive efficiencies in customer service. Ashim gave the example of Axon and doing the first draft of a police report. AI will drive robo-taxis. We have a company called HeartFlow that is using AI for heart disease diagnostics and literally saving lives. And you heard from Harley earlier today, this will be the first holiday season of AI commerce, and a company like Shopify with their catalog will allow you to find products and check out on ChatGPT. So what are we going to do? Number one, any big disruption has multiple phases. So you've heard we've made a lot of investments and a lot of money in the so-called infrastructure phase. We will, I think in the future, we'll make a lot of money from other phases that Ashim touched on, such as the application layer, as well as what I'll call real world or physical robotics. And the other thing I want to leave you with is, I've been doing this at Barron for 24 years. We've invested in lots of different innovative themes. And so we will just find other innovative themes. And for example, in my portfolio, we've had great investments in healthcare companies like Intuitive Surgical Robotic Surgery, or a company like Argenix. And we have an investment today in On Running. You would not think of that as a technology company, but it's innovative. So there's always something else to invest in. So we'll invest in different phases of AI, and we'll continue to find innovation all across the economy.
Great. Well, thank you, Mike and Ashim. Let's pivot to emerging markets with Michael Cass and Anuj. Michael, first question for you. Back when you launched the fund in 2011, cyclical plays were generally the game plan in emerging markets, but you were ahead of the curve and bought many of the kind of newer age tech and consumer stocks that have since come to dominate the market. But today, everyone knows about the Alibabas and the Tencents of the world. What is the next generation of opportunities for growth in EM?
Sure, thanks. So yeah, kind of like where are our big thematic opportunities that we're investing behind today? Let's pick up where these guys left off. I mean, obviously, the AI ecosystem and thinking about the U.S. and global ecosystem is something that we have great opportunity to invest in. We have invested in through Taiwan, Korea. Thank you, Elon, Taiwan Semiconductor, Samsung, Hynix is another, critical technology, and then a host of other, I'd say, specialized leading-edge technology companies, throughout our markets that we've been able to invest in and we're excited about. But I think what's emerged this year, which is really intriguing, and I think you touched on this, is what's happening in China, because China is kind of developing their own AI ecosystem, kind of against the odds, and notwithstanding the constraints the U.S. has put on technology flow, capital equipment, semiconductor design, they have kind of astounded the world with, DeepSeek, an LLM trained on inferior GPUs, but using, very novel kind of clustering and other algorithms to get, pretty darn good, very competitive, but on a much lower cost and capital cost. So I think we need to keep an eye on what's happening, in the China ecosystem, because they're doing it, with a fraction of the capital cost, and they're 2 years behind the U.S. So we've made a number of investments, in areas, whether it's direct AI, but humanoid robotics, the broader ecosystem, automated driving, EV technologies, and energy storage. And so a lot of investments that are related to AI that we've talked about all day are emerging in China, and we think that there's going to be more positive surprises to come there, and that's a great opportunity for an EM investor, a way to diversify from the, kind of the NVIDIAs of the world, which are a little bit further, more advanced. Another area of big sort of thematic opportunity, we really have to look at investing through the lens of geopolitics, because we said after the aftermath of the Russia invasion of Ukraine, this really changes everything in terms of capital allocation. It requires, a massive global capital investment cycle to fund what we call is deglobalization. It's really a global security, national security first world now. And so we've made a number of investments in our global security and supply chain diversification thing to play on this. Defense contractors around the world, Korean shipbuilding companies, and then a host of companies in India that are benefiting from that migration of supply chain and manufacturing, away from China. And then last, Anuj really takes the lead on our India research, but India, has always been, kind of our largest overweight, our high conviction long-term opportunity for growth and productivity. That's being turbocharged, and they're a huge beneficiary of this geopolitical shift, like I said. So that's, kind of the three areas that I would say we've been most active in the recent year or two in allocating our investors' capital.
Got it. And India was going to be my next question, so I might as well just ask, why have you guys been so bullish for so long?
Yeah, thanks for the question, Adam. So we are enthusiastic about the long-term prospects for India, and as Michael mentioned, it's the largest overweight in our EM strategy. And we last year launched an India-dedicated fund, the Barron India Fund, to show our enthusiasm. So this may come as a surprise to many in the audience, but India has actually been one of the best performing markets in the world over the past 25 years, even surpassing the returns for the S&P 500 during that period. So what really excites us about India is what we term as India 2.0, which is the productivity enhancing economic reforms that have been implemented in the country over the past 5 to 7 years. That's really kickstarting this virtuous investment cycle, positioning India as the world's fastest growing large economy this decade. In addition, the sort of inflection that we are seeing in India's digital ecosystem, thanks to the democratization of high-speed mobile broadband data, where monthly mobile tariff plans are less than $3. It's the cheapest in the world. Now, that's really empowering over 700 million Indians with a smartphone that are ordering food online for the first time, making digital payments, purchasing goods for the first time. So we are seeing a lot of great bottom-up opportunities that fits our digitization theme. Number three, as Michael mentioned, the tectonic shifts in the geopolitical landscape amid rising tensions between the US and China, in our view, is going to be advantage India, just given it's the largest democracy in the world. It's a growing economy with nuclear capability. So if you're the West, the US, or Europe, you think of India as a strategic counterbalance to a rising and more assertive China. So we are seeing a lot of global corporates that are looking to diversify their supply chains ex-China. And the example we give is Apple, where Apple was producing only 1 or 2% of their iPhones in India 5 years ago. That number is now in excess of 20%, and that's all coming out of China. And last but not the least, the financialization of savings that's playing out in India is pretty remarkable, where we are seeing the structural shift of household savings from gold, real estate, and deposits into financial products like equities, mutual funds, life insurance-related savings products, which is creating a lot of, which is firstly deepening the capital markets ecosystem and also creating great bottom-up opportunities where we have the opportunity to invest in the Charles Schwab of India or the Fidelity of India. So that's really exciting for us, and this is really what we do in Barron. Invest behind private sector entrepreneurs. India is a great ground for that.
Got it. And I think you might have touched on this a little bit in your answer, but certainly as EM investors, how has the shift in U.S. trade policy towards protectionism impacted, I guess, your day-to-day or the opportunities that you're considering?
Thanks, because I think, counterintuitively, it's actually kind of been a positive, and let me explain, the reasons, why we think that is. It's much broader than just protectionism or tariffs. It's really, the U.S. is kind of withdrawing from a multi-decade, multilateral security and trade compact. And the impact of that is kind of mobilizing. And so every action has a reaction. It's mobilizing Europe to eliminate what they call the fiscal brake and unleash, massive incremental defense spending and infrastructure spending. It's kind of causing the financial system to turn to securitization, which is a much more efficient, mechanism to finance that growth. So it's growth positive for Europe. Anuj just talked about it's mobilizing, India to double down on GST tax reform, to pass large tax cuts, to engage in rate cuts, and that's stimulative to earnings. It's mobilizing Canadian and European consumers to look for alternatives to U.S. goods and services in response to the pressure that they're under. And so I would say, in many ways, there is growth and productivity, and certainly it's mobilizing China to double down on value-added development and foster their own homegrown ecosystem for AI, et cetera. And so it's productivity and growth, positive, and that's more than offsetting the headwinds from tariffs. And we really don't invest in lower quality export type businesses, and those are very small in our indices across most of the places we invest. So it's having really a positive effect. And I'd say even bigger, if the U.S. is committed to bringing back manufacturing jobs to the U.S. and I would say, materially reducing the current account deficit. Those things are very dollar negative. I mean, there's only two ways to facilitate that, either a rise in protection of the tariffs or a much weaker dollar. And Steve Moran, who just joined, the Federal Reserve Board, wrote the book on the notion that the strong U.S. dollar in the last couple of decades has been a tax on job creation or manufacturing. So we're expecting a materially weaker dollar over, in the ensuing years. I would say the journey from globalization to deglobalization is likely to trigger a weaker dollar. That's very positive. It's very stimulative. It reverses what has been a tailwind on our economies for the last decade or more and creates a headwind because stronger currencies there means lower interest rates, less inflation, and that's very stimulative to growth, consumption, and investment.
Gotcha. We've got about a minute left, so I'll get you guys out of here on this one. Over the past 10, 15 years, EM has been a dog. It's been a laggard, but not this year. This year it's turned around. It's been looking pretty good. What do you think it's going to take to sustain that rally over the next 5 years?
Well, I'll accept everyone's condolences for choosing emerging markets as a career choice, but we think it's turning now. What does it require? It requires, greater confidence that that there's going to be an improving earnings growth potential outlook for our jurisdictions, and it's going to require sort of really 30-year trough relative valuations to begin to mean revert. We think the growth story is on track. I think the catalyst for that is this notion of deglobalization and a global CapEx cycle. It's just a fact that EM and international economies and indices have much more industrial component within the economy, within the index, and so it's a net positive. We talked about India. India's gone from 8% to 15% of the EM index. We think it's on the way to becoming the largest anchor weight, and when that happens, investors are going to think about the EM asset class differently in terms of its growth potential. Similarly, China transitioning to the value-added AI economy is very positive in terms of productivity and growth enhancing. And so these are some of the factors that we think, in addition to what we believe will be a trend towards a weaker dollar, that are going to lead to a wholesale shift in how people think about the growth potential for our universe. The last thing I would say is that in the age of globalization, the net investment account balance was in balance in 1995. What that means is U.S. investors held about the same amount of foreign securities as foreigners owned of U.S. securities. At the peak of globalization a couple years ago, that became a $34 trillion imbalance. And so that is what sort of unwinding globalization, diminishing, moving towards deglobalization, kind of, I would say, presents the likelihood that that $34 trillion begins to migrate back out of the U.S. securities into the home countries as those currencies strengthen. It's a huge incentive to move your capital back in that direction. That's really what's going to sustain, confidence in a longer-term earnings cycle and performance cycle for non-U.S. assets.
All right, well, only time will tell. That's all the time we have for our panel today. Let's give it up for our panelists.
As Chief Operating Officer, I have the privilege of working with our outstanding employees across the firm to accomplish our mission of changing lives.
For me, changing lives means building relationships that last decades.
When hiring analysts, we of course look for people with strong analytical and communication skills. But we also look for people who are intellectually curious, have a passion for investing, and are committed to identifying companies that can transform their industries, and in some cases, the world.
I'm a Buffalo Bills fan, and before every Bills home game, the crowd joins together in a cheer that goes, "Where else would you rather be than right here, right now?" Well, that is how I feel about Baron Capital.
Our mission is to provide our clients with investment options that will make a difference.
When we invest, we're looking to identify visionary leaders running these transformational businesses. This is how we generate our strong long-term returns. And in doing so, we're also supporting innovation that changes lives across industries, from healthcare to technology and beyond.
That's what drives our team, connecting people to possibility.
We are blessed with a great opportunity to do something together that truly matters. For families saving for college, retirees relying on a pension, and entrepreneurs building the next great company. I'm proud of what we do and the people who do it. So go Baron and go Bills.
Please welcome back to the stage Ron Baron, Baron Capital founder and Chief Executive Officer.
I like that song. Before I start, we've been sitting quite a while. I normally give you a lot of time to move around, but why don't you move around for 2 minutes? They have Carmen here tonight, which they sort of like to do. So we have to keep a real tight time frame. But if you want to stand for a couple minutes, move around a little bit, get some oxygen flowing. Say hello to your neighbor. Thank you all very much for coming here today. Okay, let's go. Please be seated. So in August, this is the start. So in August, I was at the Mayo Clinic in Rochester, Minnesota for my annual physical. The Mayo is a pretty serious place. When it comes to my health, I don't fool around. I was standing with a group of doctors waiting for my next examination when an older man, who's probably younger than I am, caught my eye. "You're Ron Barron," he said. "There's something I need to tell you. You've changed my life. Thank you." Which for some reason made me tear up, which happens almost every day. Not the tearing up, but the thank yous, virtually every day, which never failed to touch me. And which inspired this year's Changing Lives theme. That and the awesome impact of AI will have changing our lives. Today is the 32nd annual Barron Investment Conference. Every year, I look forward to this day, the same way I look forward to fraternity house party weekends in college, when we were entertained by the party band Hot Nuts. That's their name, just like Otis Day and the Knights in Animal House. The Hot Nuts, by the way, were banned from Bucknell my senior year. And we were going to bring them back to entertain you for lunch today, but I decided not to. Today's meeting may look like a party, but it's not. Barron Capital, like the Mayo, is a pretty serious place most of the time. Today, we want you to have a good time, but most of all, we want to thank you for trusting us with your savings. That's enabled Barron to achieve what Bloomberg and Morningstar call success envied by Wall Street. Your trust is also at the core of our mission to change the lives of you, your families, and our fellow employees by making you financially secure. Barron's Changing Lives theme this year is about more than improving your finances, though. It's also about how progress transforms lives. Barron believes humanity is beginning its most important epic yet, the intelligence revolution, due to awesome possibilities created by science and engineering and profoundly influenced by our friend Elon Musk. Today we're going to talk about 4 topics: living through revolutions, our origin story, the opportunities and unknowns of AI, and why our process didn't change. The agricultural revolution for the past 10,000 years changed farming practices, marking the end of eat what you kill. The Industrial Revolution of the 1880s led to mass production facilities and unprecedented growth. People were worried about it when it happened. And the 1990s information revolution, enabled by the internet, transformed communications. Until recently, world economic growth and life expectancies had increased arithmetically for 5,686 years. Anyone know what that means? Since the dawn of civilization. Well, people define it a different way. We now expect exponential. By the way, when I was a child and that movie was playing, people were so excited about going to see Charlton Heston. Anyway, things have changed. We now expect exponential economic growth, and that was 10 Commandments. We now expect exponential economic growth and drastically improved healthcare and life expectancies because of AI, beginning now, right now, today. We chose the imagery captured by the James Webb Telescope of first light 13.5 billion years ago as illustrative. That was when dust from the Big Bang, the nebula, coalesced into stars. 500 million years after the Big Bang. So now we talk about ancient times, 5,000 years ago, 10,000. This was 13.5 billion years ago. Crazy stuff. We believe that evolution has not stopped, and our lives and health and even the physical appearances of our children's children and their children will be a lot different than we expected. I didn't say better, I said different. Finally, because of AI and machine intelligence, Elon believes planet Earth could achieve what he calls sustainable abundance, which he and I discussed just now. We sure hope he's right. We met Elon in 2010 and have been an investor in his businesses since 2014. It took me a while. 15 years I've been following this company. And if you think it's easy, when a company grows so fast and changes so much, to follow it, I mean, it's hard for me to understand how he manages it, but following it is an incredible task. Anyway, today Elon's Tesla, SpaceX, and xAI represent about 24% of our assets, due to realized and unrealized $13 billion in gains. Made $13 billion from him so far. I think we're going to make 5 times that over the next 10 years. 5 times more. Barron Capital's Big Bang, that's our founding. That was our first, when we now give away Teslas. We gave away a bone. That was, that was our first one. So people look at me now and say, man, you're so straight. I'm not, it's inside. It doesn't come out anymore. So I'm an analyst, first and foremost. My X handle, @RonBarron_analyst, says it all. I'm an analyst. I became interested in a career as a financial analyst in 1966. The Dow Jones Industrial Average was 1,000. 16 years later, 16 years, in 1982, it was still 1,000. Since 1982, though, the Dow has increased 50 times. It's now 48,000, 1,000 to 48,000. We outperformed in the 1970s when the index didn't change, and when the market went up 50 times since 1982, we outperformed again. We think stocks of growth businesses are better investments than gold and better than Bitcoin, too. We believe markets and our economy will continue to at least double in size every 10 to 12 years, as they have during my entire 82-year lifetime. The big lessons? I agree. Don't be afraid. Don't ever be afraid. And like Elon, never give up. We founded Barron Capital on March 15th, 1982. The Ides of March. A good day for us, not such a good day for Caesar. I intentionally founded it on March 15th. Shows risk-taking. Barron then had $10 million AUM, 10 million, all from one investor who had given me $5 million to manage in 1977, which I had doubled in 5 years, which led my client to advise me, when you find investments with outstanding growth prospects based on your research, not on someone else's advice, you cannot possibly own as much as you should. Perhaps one of the best lessons I ever got. We've had lots of winners since then, 10 times, 30 times, 50 times, 100 times. Charles Schwab, Arch Capital, Hyatt, Wynn Resort, Choice Hotels, Federal Express, Disney, Tropicana, MSCI, Manorcare, Nike, Tesla. We can go on, and potentially the biggest yet, SpaceX. With each one, I relied on Barron research, not outsider recommendations. By the way, SpaceX, you can buy by investing in our mutual funds, and if you want to go buy it from someone who's doing you a favor, they charge you 20% of your profits and 2% of your assets every year. We are doing this because we're trying to let people know that we're on their side and we're the same as they are. In 1992, we managed $100 million. We currently manage $46 billion and have earned more than $52 billion of realized and unrealized gains. So we managed 46. We made $52 billion in profits from $100 million in 1992. Pretty amazing. It's a good thing. It's a lot of luck, but it's a good thing I didn't get into medical school. I didn't get into medical school, but I was good at parties. I try to walk around our 3 tower floors in the General Motors building on Central Park every day, speaking with our 212 or 217, Cliff said, young, talented, hardworking team members chosen for their character, intelligence, work ethic, curiosity, and passion. And it makes me feel that when I look at them and meet them and shake their hands and talk to them, it makes me feel like we're just getting started. I'm working with my 2 sons, David and Michael, our firm's co-presidents, for the past 22 years. Makes it hard to imagine how I could have a more meaningful life. Most investors focus on daily stock price changes, quarterly earnings, tariffs, wars, politics. In other words, short-term results and the macro, and often invest using math and algorithms. And now predict bubbles and crashes, which we believe are not predictable and not even relevant if your investment horizon, like ours, is decades, not quarters. So if you think long term, it just doesn't matter. It's just a line up, and these things are just little blips. Others are anxious over expected returns that could be earned from AI capital investments, and that AI will take jobs from blue-collar and white-collar workers, causing recession. Data center and AI capital spending are now front-page news. Data center investments are the largest capital deployments on planet Earth ever. That's what xAI is doing. That's the investment that we've made, and the $350 million so far is now worth 700, and the next pricing is probably going to be worth $1 billion to $1.25 billion, I don't know, something. But it's going to be worth more than it is right now. Our guy's valued for $100 billion, and ChatGPT is valued for $500 billion. Doesn't feel right. Hundreds of billions annually, trillions ultimately, by super successful entrepreneurs. That's who's making these investments. Plus, sovereigns want to, go along. Many of whom believe they will not be able to satisfy demand for compute in their lifetimes. As much as they're building right now, they feel it's not going to be enough to satisfy the demand that they see for what they're building. Yet every day, we read about possible AI data center overbuilding. Further, data center projects are now so expensive that the builders and owners need sovereign nation participants to help finance construction. That's what I mentioned before, who are standing in line to participate. So big sovereign funds want to participate, and they're paying premiums to get in, and they're not able to invest as much as they want. Within 10 years, we expect, as do Elon and Jeff Bezos, to build data centers in low Earth orbit, provisioned by SpaceX to harness the energy, first of our planet, which Elon thinks is now about 5% of the energy we could get from our planet, to harness the energy of our planet, and then of our sun, which he talked about soon, and ultimately our galaxy, to power and cool data centers. So if it costs so much to cool a data center on this planet and to power it, why wouldn't you just use the sun for free? And why wouldn't you use the minus 250 degrees, to cool it in space? So it makes sense once you get it up there. I don't think it's going to be 5 or 10 years. I think it's going to be sooner. Musk estimates Earth is now using 5% of the energy we could from our planet. Less than a trillionth of what could be harnessed from our sun. Way less, not Waymo. Get it? In the meantime, since America's energy grid is being obsoleted and is fully utilized during peak daytime hours, It's boom time for Tesla's massive industrial storage batteries. That's a $4 billion a quarter business right now, and they're making about $1 billion a quarter, and it's been growing 30, 40% a year. Tesla batteries that purchase utility electricity off-peak hours could double electricity available in America with no further investment in utility peaker plants. Data centers currently use 3% of United States electricity, which is going to increase to 8% in 10 years. So in the daytime, you get charged a premium rate, and at nighttime, when people want less energy, it's a real discount. So when you take the energy that could be produced at night and just buy it and put it in a battery, and then you buy it at low prices, then you sell it back to the grid at high prices in the daytime. That's what our battery business is now. That is meeting unprecedented demand. The competitor is China. But with China, if you're at war or something bad happens, do you really want a foreign nation to be in control of your energy? That's what we're providing. We're providing that service with our Tesla Energy. Mary Daly heads the Federal Reserve Bank of San Francisco. To understand economic activity in her region, Mary regularly visits to talk to people and observe businesses firsthand. On a recent ride from Salt Lake City's airport to downtown, she caught up on the news. It felt really pessimistic, she said. But driving through town, she saw activity everywhere. Full parking lots, busy retail outlets, and most importantly, construction cranes. The cranes, she noted, told a different story. Cranes are expensive, and businesses only build when they're optimistic. That visit gave Mary confidence that business was much better than news reports had portrayed. In other words, she believed what she saw, not what she read, which was similar to the advice my grammar school class received from our counselor on graduation day 1957. He said, "Don't believe anything you hear and believe half of what you see." So I'm 13 or 14 years old, and that's what I'm hearing from our guidance counselor. How scary is that? It sure fits a question everything pillar. One more thing. The spectacular market advance over the past 25 years was concentrated in large cap technology businesses. Smaller and medium-sized growth companies dramatically underperformed. Barron funds and partnerships and managed accounts that invested in technology companies, they did great. Barron funds that own small and mid-sized entrepreneurial growth companies, not so much. We think many smaller and mid-sized growth stocks, which have been ignored, now offer awesome opportunity, totally awesome, in part because of AI's ability to affect their revenues and their costs, also because they are so effing cheap. That was okay. As investors, we consider ourselves lucky to be alive in America, the greatest city in the world, at least for now. We'll see what happens soon in the age of AI. That's what I believe New York is, the greatest city in the world.
Space, the final frontier. This is the journey of the Barron Capital Enterprise. Its mission, to change lives. To boldly go where Ron Barron has never gone before, saying something different.
So my wife says I say the same thing all the time. So this one made sense to me. We tried to get William Shatner. I found out from one of my friends, his agent, but unfortunately I found it too late, and we tried yesterday, and we didn't get it done. Which is upsetting. I'll get it some other time. He's only 95. Got a lot of years to go. I've described our investment process in excruciating detail at each of our prior 31 conferences. Our process has been successful, which is why it hasn't changed, and I'm not going to speak about it today. With one exception, AI will enhance our research, by providing extensive explanations of complicated technologies in minutes that used to take us hours to learn. So AI for us as an investor is going to be fantastic. It already is. It's going to be better and better and better. What's actually changed through the years, though, are the facts and circumstances of what we purchase, our holding periods, and our absolute obsession with the character and the culture of a business, the soul of a company. We hire and train extraordinary individuals as analysts to conduct interviews, visit companies, and help us identify superior, managed, unique, competitive advantage, singular growth companies. If we're uncomfortable with executive character, regardless of how favorable we believe a business prospects, we're not going to invest. Our questions, as a result, are different than others and get really personal, about their families, backgrounds, and lifestyles. Our decades of one-on-one conversations with executives asking questions that reveal to us who they are, who they really are, is Barron's secret sauce. Where do you buy that? Which is what we say, which is what we mean when we say we're different. We invest in people. In addition, we teach our analysts to identify what Fred Stein, one of Cliff's and my favorite clients years ago, called dimension, open-ended growth opportunities. About Fred. During the past 50 years, 21 companies were created in America's garages, college dorm rooms, and basements that now have market capitalizations of more than $200 billion each in basements, garages. Among them are some of the largest technology companies today, referred to as the Magnificent Seven. I think it's 38% of the S&P are those 7 stocks. The founders of 10 of those companies are Jewish. Founders of 12, yay Jews. Founders of 12 are either first or second generation immigrants. The United States population is 340 million people. 2% are Jews, 24% are first or second generation immigrants. Jews and immigrants are risk takers by necessity, not by choice. We believe the biggest risk is not taking risk. Due to generative AI, in the next 50 years, entire new industries will birth businesses we can't even imagine and increase existing business profits materially. Talk about businesses with dimension. We believe the next 50 years will produce what we call a seismic 16. Transformational businesses that will disrupt and redefine industries. We had a big argument about whether I should include that. But listen, when you're building something new, it has to take something down sometimes. They wanted me to make sure I didn't have people dying underneath that rock. AI will enable the creation of more $200 billion market cap companies in the next 50 years than in the past 50. Due to growth and inflation, Today's $200 billion company in 2075, 50 years from now, would imply a market capitalization then of $6 trillion each. So a $2 billion value company today be the same in 50 years is $6 trillion. It's our job to discover and invest in those businesses while they're young and growing rapidly. We expect companies like SpaceX, CoStar, MSCI, Spotify, Shopify, XI, and Tesla to become perhaps 40% of our portfolios, maybe even more. But not our entire portfolios. Too risky. Many unique double-digit growth businesses in healthcare, real estate, industrials, consumer, and innovative finance with exceptional management teams like Hyatt, Red Rock Casinos, Arch Capital, Gartner, Morningstar, and FactSet provide a sound foundation that allows us to own riskier, very fast-growing businesses that benefit the most from AI. We're really anxious to invest in America's rapidly changing and accelerating growth, autonomous, electrified, digitized, AI-driven, sustainable abundance economy that Elon describes. There is so much opportunity on planet Earth, it's often difficult for me to sleep. It drives my wife crazy. It's hard for me to sleep, though. It's so wired. Not getting any easier since opportunities in space are limitless. Our process starts by hiring talented individuals whose character and family backgrounds we believe give them the best chance for success. In addition to being smart and intensely curious, they're really hungry. A CEO friend founded cellular, telco, and cable TV businesses 30 years ago, before the internet bubble burst. He believed Baron Capital escaped nearly unscathed when the bubble burst due to our process. He said, Ron tore apart and reassembled those businesses in his head. That's how we train our analysts to learn about businesses, the essence of them. What's potentially positive or negative. It's to learn how businesses really function and to judge the character of the CEO founders. One of my favorite executives is Henry Fernandez, MSCI's founder and CEO. He recently gave me a wonderful compliment. Ron sees what others don't. Thank you, Henry. Another of my good friends is Hyatt's chairman and principal owner, Tom Pritzker. Noting I never seem to be without my iPad taking notes, Tom suggested that to help David and Michael the most, I should make sure they inherit my digital notebooks, which I'm going to do. These days, I spend much of my time teaching my process to others. We believe the Seismic 16 will consist of more than large-cap technology growth companies, data centers, chip makers, and generative AI, although we're going to have plenty of those. We've earned more than 75% of our $52 billion in profits. Remember, it had $100 million in 1992, $52 billion in profits in businesses other than EVs, spaceships, satellites, energy storage, data centers, and soon robots. For example, in 1992, we believed Charles Schwab's mutual fund marketplace would revolutionize mutual funds distribution. That's Chuck at our annual meeting and me 5 or 6 years after we started. We still own it. We made 100 times our money so far. Judy and I had a recent Friday night dinner, pizza dinner, with Margie and Roy Furman. Roy is the vice chairman of Jefferies, a fast-growing, extraordinarily well-managed institutional brokerage firm in which Barron is a shareholder. That's our dinner. I want to show one of the people. During dinner, Roy asked Judy if I had told her about Charles Schwab's earnings report that day. I hadn't. Assets at Charles Schwab increased from $60 billion in 1992, when we began to invest in Schwab, to $12 trillion. Stunning, Roy remarked. Absolutely stunning. 200 times. Judy and I recently watched the incredible Broadway actor Jonathan Groff portray Bobby Darin and just in time. At the show's end, Jonathan was standing less than 5 feet from me. When he tried to explain to the theater audience how much this role affected him, his tears were flowing. I'm 5 feet away from him, and he's sobbing. It didn't feel like acting. I was made for this. I can't believe I get paid for this. That's exactly the way I feel every day.
Oh, the shark bait has such teeth in, and it shows them pearly white. Just a jackknife has old Maggie bait, and it keeps it out of sight.
I used to love that guy. He died, by the way, when he was 37. And he had rheumatic fever when he was a child, and that's the early death. And so his doctor told him his dream was to perform at the Coca. And his doctor said, if you do this again, you're going to die. And he got some bad news about his life, and it really upset him. And he then booked himself for 7 consecutive days at the Copacabana and died. I've been an analyst for 55 years, and I still can't believe I get to meet, question, and learn from the most extraordinary people every day and invest in ideas that make the world a better place. For me, it's never been about making as much money as I could, as fast as I could, so I could go somewhere and just sit on a beach. It's always been about impact, about changing lives. I want to thank you again for believing in us. And I want to say to you what that guy in the Mayo Clinic said to me, you've changed my life. Thank you.